Hey, what's up, guys? It is me back with the trade of the day, the live trading here in the stock market on what happens to be the largest single day drop ever in stock market history, guys. So, pretty incredible things going on here. Let me get out of that. The SPY right now is just tanking. It is. We'll see if it gets below that little candle there, or if it makes a double bottom here. It might be time to go long, guys. I'm pretty excited to see here what we've got. There I am. Oh, I got some terrible things going on in the background here. Let me fix up my lighting here, and then I'll be back on. Man, guys, the market is just tanking today. It is literally. I've been, watching the stock market now for approximately probably 20 years. Since the 2000s and the 2000 bubbles, and I have never in person live ever seen a drop this large. So that goes to tell you guys, it has happened a couple times, over the last 100 years, but nothing like this. This is like 2008 style. Let's see here. And it's all pretty much, related with the coronavirus news. I talked about this last Friday, guys, that basically what I thought was going to happen is a lot of people were going to, a lot of the cases and a lot of people were going to meet up with their friends on the weekend, and a lot of people were going to be talking about this coronavirus, and it was just going to set, the fear in people's eyes. I want to check out this Nike stock here. Whoops, what just happened? What did I just do? I'll go back to my charts here. Oh, well, guys, if you've got some of those Bank of America puts or Uber puts last week, you guys were doing extremely well, like I talked about here. It is pretty crazy how big of a drop we are currently experiencing. We're at lows of the day too, for the most part, besides that big spike down. Let's get in here a little bit further in, see where we really are. Obviously nothing from this morning, nothing from the big drop there this morning, but man, there we go. I do not have a mouse set up here, guys, yet, so just bear with me. Let's go through watching. This is my watch list here, guys. I want to show, holy moly, UVXY is at $45 now. Guys, we were looking at that at $30, literally, Friday. TLT, we were looking at that at $150. So everyone, what is going on here? Basically, when the whole entire global economy slows, except the banks are printing money, you're going to see gas prices just completely tank here, and you're also going to see oil prices tank. You're going to see almost the entire market come to a big halt here. That's what the traders are going to believe. The traders, they are going to go in there and they're going to look at this market, and they're going to see, hey, if we slow down here, 10 or 15%, we could have significant pullbacks. The reasoning is because everyone's leveraged up again. So I kind of like this chart here. It shows that big drop here after hours in the pre-market also. So since Monday here. Now, like I said, guys, this could be opportunities to start picking up some calls on the other side here. Let's see if I can find. Let's check out Walmart stock. Walmart got bought up pretty significantly. Uber's still tanking. And American Airlines, let's see here, still tanking. Those puts were working great. This little coronavirus play that I have here is not working as smoothly as I thought it would, but everything else, let's go look at the TLT here. TLT. This is when we were talking about it, guys, and then it's just it's just risen. It has, what has happened is the bond yields have just tanked, and in reverse, basically what's going to happen is this TLT is going to continue going up, and at some point, you know, math gets parabolic, so we'll see how high this continues to go. And let's see here, Disney. Guys, I love Disney. Disney is such a solid company. They pay a great dividend also. And I mean, I remember back years ago when Disney was $60, $70, and now after the market tanking as much, it's still at 106 here. Let's go ahead and see if there's a broadcast available here. See what the people are saying on the worldwide internet TV.
$55, $50 oil on the books.
Woo!
With that are going to be able to ride
WTI crude, $32. Man, that's really going to hurt the economy too. So, another thing that we got going on right now, guys, is that you know, Russia and Saudi Arabia are playing with the oil market, and they're probably thinking that this is going to be like a global economic war where China and these Asian countries go and they try to buy up all the gold. Let's go take a look at gold here.
But the effect is the same.
And all the silver, and then we have
before we even take into account the
you know, we have
sort of economic spending
the Russia and the Middle East area and Africa all trying to get as much oil as they can so that they can continue surviving out there. And it's just, man, this market, it's tanking this market.
Today, whether it's in some of the crude names, just stocks in general, nobody seems to be cheering this move. Plenty of people are saying, in fact, it didn't go far enough. Others say they shouldn't have done it at all. Now the market downturn is intensifying. Crude prices are collapsing, and the whole question
definitely
is
expect there to be more quantitative easing, and that I believe just makes this go way up even higher.
That's the real problem. I think the market is screaming out, and I hope that
this could get to $200, $300.
This issue is that fiscal policy
The TLT could.
Here. And as Randy pointed out earlier, I know Randy well, and he's right. I mean, you can issue debt if it's for a good reason, and this is for a good reason. We need to bridge this turbulent time. We need to worry about not just the oil industry and bankruptcies there, the effect on the overall credit market, and we need to stop that from mutating into a full-blown financial crisis. And the way to do that is not just with Fed rate cuts, although we will get more. We'll be at 0 by April. I do think that it's much more important to also step up on fiscal policy to bridge this period in time so that we have something to rebound off of once we get through the disruptions created by the coronavirus.
You know, it seems to me the financial system was operating fine when participants didn't think we were in any danger of going to zero. And as soon as that came in sight, and it really came in sight with the half-point cut last week, everybody just piled into Treasury saying, we're going to zero, quantitative easing is going to be next, and you can't blame them. I just wonder, should the Fed have stood up and said, we are not going to cut rates here. It's too soon to know the impact. It has to be fiscal policy. Look, yields didn't go up after their action. They've gone to unthinkable levels.
It's a great question. In hindsight's 2020, but I think the Fed was in a catch-22. They were actually priced in to make a cut, and once they said they were meeting and having that collective meeting among the G7 finance ministers with Chairman Powell on that call, you did expect some coordinated rate cuts, and that is exactly what we got. The reality is that we knew going into this that if we hit a really bad economic time, the Fed was limited in what they can do. And I think that's what's coming home to roost now, is that we need to rely on fiscal policy. This is not something that Congress and our elected officials can sit out. They have to step up and work with the Fed, coordinate how they're going to deal with this. This is, back to the crisis. We know one of the lessons of the global financial market crisis was that we didn't step up enough and keep stimulus going enough during the crisis to make it less painful. And austerity became an issue too soon. This is not the time to be thinking about austerity when it costs nothing to issue this debt. There's good reason to issue it to bridge this period in time for very many good reasons, as Randy pointed out.
No, I haven't heard the word austerity in years. I don't think anybody's thinking about that yet. They might be a little worried about moral hazard, but I want to go back to something that you said about, what the market has priced in, and that's, I don't know why the Fed needs to worry about that. I mean, if the idea is we want yields to go back up, we're worried about the price action in stocks and bonds. A fiscal announcement could have solved that the first time. It can still solve it now. If the market thinks the Fed's the only game in town and the Fed feeds that perception, they're going to make the Fed cut to zero. Doesn't mean they should. You know what I'm saying?
Well, they still have to. I mean, the reality is if we get into a disorderly kind of correction, they don't really have any choice. All bets are off. It is their job to go against, to try to stimulate as the economy falters. And it's, unfortunately, they do not have the ability to force the rest of Washington to do something. And I don't think holding rates up high to try to do that is the best way. We did see that once in the past. That was in 1990, and it didn't turn out so well for the George W. Bush, H.W. Bush administration, when Alan Greenspan withheld easing to try to get to austerity back then, to try to raise taxes back then to reduce deficits, and we ended up in a recession that we had a hard time getting out of. It's just not something, a game the Fed can play. It's out of their lane, and I think that's the hard part, is they have to respond to the economic fundamentals, and those are deteriorating quite rapidly, and that's what they're responding to.
Yeah, I'm just saying, if they got up, even now, and said what I'm sort of calling a coronavirus Marshall Plan, right? If the government is going to spearhead this massive effort, then it wouldn't have made a difference.
That would be great. I agree.
It wouldn't have mattered how much the Fed cut. Arguably, the cuts would have been irrelevant.
Well, I'm not sure they would have been irrelevant, but it certainly would be the lesser of the problem, and we wouldn't be looking at the Fed to shoulder a burden we know they just can't shoulder, and I think that's what you're seeing. You're seeing markets scream out and say, please help us with fiscal stimulus. We need something here to get through this period in time. I mean, how can low energy prices help consumers who are no longer going out to sporting events, no longer going out to conferences, no longer driving as much, or staying at home away from work, or not able to work? It just doesn't have the same kind of positive impact that it once did either, given all the other changes, and the knockoff effects into credit markets are quite significant.
All right, Diane, thanks. Diane Swank from Grant Thornton joining us today to talk about what those next moves might be. Let's go back to what's been happening in the oil patch. Today's historic drop in the oil price has investors wondering what could be the next shoes to drop. And for more on what that means for the industry, I'm joined by Chris White. He's the chairman and CEO of Liberty Oilfield Services. Chris, thank you for coming on TV today to talk about what's happening. Are there any misconceptions, you think, about how bad this looks for the energy industry right now?
Well, Kelly, I think people sometimes confuse the short term with the medium or longer term. Our industry, because of efficiency gains, has been contracting in size and reducing investment to better balance supply and demand. This adds fuel to that fire, and therefore I think you'll see the contraction of investment and contraction of U.S. oil production accelerated faster. So painful in the short term, but probably brings us to a better place for the stronger companies. I was amazed to read you guys were founded in 2011, and just so people are aware, you provide the services to the oil patch. Like we always say, kind of like selling picks and shovels in the gold rush. It's a good place to be until slows down a little bit. So you were founded in 2011. You've never had to do layoffs or reduce your workforce, as I understand it. You have more cash than debt right now. I mean, your company, I guess you've been through 2016, but this is going to be quite a trying time. It will be. It will be. 2016 was quite a trying time. You know, we had $26 oil. We had in the regions where we operated, the rig count collapsed by 2/3. Here, maybe we get a 1/3. I mean, I think we'll get a meaningful pullback. I think it will be stressful times. And those are tough to go through, but they ultimately work to the advantage of the stronger players. And I think there's a number of strong players in our industry that'll be better for it. Yeah. But yes, this year will be a tough year for our industry.
So how low for how long does oil price need to be before a company like yours has to really trim the workforce considerably?
Hard to say. You know, really our activity is dictated by what our customers are going to do. I think it's a certainty that our customers, the oil and gas producers, are going to shrink rigs and they're going to lower their demand for frac services. So the whole pie is going to get smaller. Liberty will do what we always do, which is to try to grab a larger slice of that smaller pie. And then the other question is, how long does this last? Mm-hmm. And as you heard Dan Yergin and others say, the pain at mid-30s oil, it's not just in our industry, it's around the world.
Yeah, but
so I don't think it's long-term sustainable.
Maybe not ultra long-term, we are running out of time, but he suggested it could be a year.
I think very possible. It's probably not likely that oil prices stay this low for a year, but I think very tough conditions and contractionary environment lasting a year is very believable.
And your company can get through that?
Absolutely.
All right. Chris, like I said, we thank you for coming on TV today.
Kelly, thank you for having me on a rough day.
Not for the faint of heart. Chris Wright is the CEO and chairman of Liberty Oilfield Services, one of the many companies affected by the huge plunge in oil today. And that's only one of the things going on in this market. We'll continue to watch it all closely, follow the action for you on Power Lunch. Thanks for joining me today. I'll see you there.
All right, thank you very much, Kelly. We will see you in just a moment as you join us here. It is a historic day on Wall Street with all of the major indexes down by record amounts. The Dow is within about a percentage point of bear market territory. Oil having its worst day in nearly 30 years since the Gulf War of 1991. Dow, lowest level since January of 2019. So, what's going on? Well, you've got Russia and Saudi Arabia duking it out in an all-out price war. That has sent crude down as much as 30% today. It is down very strongly from just a month ago. The energy sector down a whopping 19%, on pace now for its worst day ever. And the carnage bleeding into the bond market. The entire yield curve is under 1%, including the 30-year yield, which is just below that level. You see it there at 0.89. Kelly, an amazing day.
Yes, it is. Ty, thank you so much, and welcome to Power Lunch, everybody. I'm Kelly Evans, and we've got all the angles of this historic sell-off covered. Bob Bassani is watching stocks for us. Rick Santelli tracking the historic lows in bond yields. Eamon Javers is at the White House with all eyes on the Trump administration's response, and Steve Leisman on the Fed's next move. We'll start with Bob at the NYSE. Bob?
And Kelly, we are essentially back at the lows for the day. And again, that 7% level becoming very important because of the circuit breakers. Here we are. We had that halt there at 9:33 Eastern time, down 7%. And right now, down 7.2%, you see in the NYSE. Let's review those circuit breakers because they were very important this morning. Again, these are long history, but only used actually once. Level 1 down 7%. We saw that at 9:33, halted for 15 minutes. There's no other halt if we're down 7%. Next level is down 13%. That would be another 15 minutes until 3:25 p.m. Eastern time, and then there would be no trading halts at all unless we went to level 3 down 20%, and that would halt trading for the rest of the day. These circuit breakers have had a very long history. This all goes back to 1987. Remember that 22% drop in October 1987? Everybody said, well, we need to do something after that, and they did. Until 1997, we just used a point rule, points in the Dow Jones Industrial Average, and they went to a percentage on the S&P. So we revised it several times, 2013 most recently, and it's only been used actually once, back in 1997 during the Thai baht crisis. So this is all new. We haven't seen it with the revised circuit breakers this ever happening before. You want to see a rough day, what circuit breakers are like? Here's Halliburton, halted by the S&P halt at 9:33, then halted again at 10 a.m. on an individual circuit breaker because it was down, limit the decline there, and then halted again at 10:22. 3 trading halts in one day. That's a pretty rough day in 1 hour. I haven't seen that ever before. The important thing here is nobody knows how to price these energy companies because no one has any idea what the earnings are going to be. So they're gyrating all over the place. There you see the banks all down here, and the Dow Jones Industrial Average, guys, now down 2,000 points. Back to you.
Robert, thank you very much. 2,000 points, 7.8% on the Dow Jones. The entire yield curve now below 1% for most of the morning. Rick Santelli has been tracking the action for us from the CME. Rick.
Yeah, it's a wild session, no doubt. I've heard many say they've never seen bid-offer spreads this wide. You know, listen, I remember night sessions before computers were popular in the 80s and early 90s. I remember some wild night sessions. All I can say is when you have machines, you have this thing called a plug, and you can unplug. Many of the machines in futures last night weren't going to get involved. And that's one of the big issues with machines. Sometimes they're turned off. Look at an August 1st, 2014 start to 2 year. We're going to settle somewhere in the 2014 fall area, as you can see on this chart. If you look at 5-year notes, I put a 10-year chart to prove we have now everything 5-year on. We have taken out all previous lows and moved into history. 1 week of 10s. See, this chart isn't exactly right, and I'm not being critical. Many charts connect the dots, but there's a gap. Friday's lowest yield was 65 for a 10-year. Today's highest yield is 60, but the lowest yield is 31. That gap, most of the time you come and fill them. That's some good news if you're looking for yields to come up a bit. Finally, HYG, kind of a proxy for what's going on in the credit markets. Yeah, it's deteriorated. But if you look at a long-term chart to 07, you can see there's plenty of periods that were higher. End of 2018, let me think, early 2016, 2008, 2009. Perspective. Finally, tens minus boons. This narrowing actually may be a good thing. Maybe these central banks can all get together and figure something out. At 137, it's the closest those two yields have been, our 10s, European 10s, since September 2015. Kelly, back to you.
All right, Rick, thanks. And let's look at the Dow and the S&P, which have headed right back to their lows. In fact, they hit new session lows right now. The Dow's down 2,061 points. That's just about 8%. 23,800 is the level after we nearly hit 30,000 earlier this year. The S&P is down 7.5% today. It's down to 2744. The NASDAQ just shy of hitting the 7% mark itself. The White House considering options for a possible response as these markets continue to plummet. Eamon Javers joining us with more. Eamon?
Yeah, Kelly, a couple of meetings here on the schedule to keep you up to date on. One is later this afternoon, we are expected the president to meet with his economic team to consider some options here to respond to this economic damage that we've seen. We're told he's going to be given a robust list of options of what to do. No indication there's going to be a decision to make, but the president will be arriving here at the White House within the next hour or so. He's been down in Florida attending a fundraiser today. And on Wednesday, we're now told that the president is going to be meeting with Wall Street executives. Not sure exactly which CEOs will be here, but that meeting, those invitations are going out as we speak. So we'll have more for you on that in the coming hours, I'm sure. Meanwhile, a couple of tweets here from the president to give you a sense of what he's thinking today as he watches all this unfold on his television screens. He says Saudi Arabia and Russia are arguing over the price of oil. That and the fake news is the reason for the market drop. So the president sort of blaming the oil markets and blaming media coverage of coronavirus as part of the reason why we're seeing this today. He says, good for the consumer, gasoline prices coming down. So that also gives you a sense of the White House's thinking here on these oil markets is complicated because they do feel that it is a boon for the economy in certain sectors if oil prices are low. On the other hand, they fully are aware of the damage to the fracking industry and others from those low prices. And so they're trying to balance both of those in their considerations here. Not clear they're thinking about taking any action in terms of the oil market specifically, but we should have a better sense of things, Kelly, after this meeting at the White House once the president gets back to town.
Okay. Eamon, we appreciate it. Thanks, Eamon Javers.
You bet.
And traders are now betting on another massive rate cut from the Federal Reserve as early as next week, taking us closer to zero. Steve Leisman has more on that. Steve.
Tyler, thanks. Growing concern about the way fixed income markets are trading has some market participants saying that the Federal Reserve may need to do much more than just cut interest rates. There are calls for them to break out some of their programs from the financial crisis to resolve liquidity problems. Kelly and I just sat down with Bob Michel, head of Global Fixed Income, Currency and Commodities at JP Morgan Asset Management. We asked about unusually large bid-ask spreads in the Treasury market. Here's what he said.
Steve, I've been doing this 40 years. I've never seen that before. Last night, I got a message from our London offer our London office, there was no offer on the 30-year Treasury futures. We've never seen that before. So these are uncharted times for sure.
This morning, the New York Fed announced it was increasing the size of its overnight repo operations to $150 billion from $100 billion, providing liquidity into the market. It upped the amount of its two-week repo to $45 billion from $20 billion. That prompted former New York Fed official Krishna Guha, now at Evercore ISI, to say, quote, "It is a baby step with only short-term changes, limited-term funding, and no global reach. In our view, much more will need to be forthcoming, and very soon." Market participants I'm speaking with calling for the Fed to cut 100 basis points over the next two meetings. Barkley just out with a paper calling for that. Loosen some regulations for banks that might enable them to provide additional dollar liquidity to the markets, and other crisis-era liquidity programs to provide more funding into the markets. Luckily, the Fed has converted what were temporary into standing dollar swap lines with Canada, ECB, England, and Japan. And those dollar swap lines should enable those banks to borrow dollars as needed to resolve any dollar funding issues that may come up. But it just seems like it's taken a step towards the worst today in terms of the interbank thing that seemed like it was okay last week. I'm just hearing more alarm now. I don't think it's DEFCON 5 at this point, but I think it's worse than it was on Friday.
And it was interesting to hear Bob Michaels say that despite all the kind of extraordinary central bank stuff we're talking about now, that
these dislocations, between the bid and the treasuries. So I asked him specifically about that. He said, and I'm going to quote here, and I think we have some of these. If not, I'll put them up afterwards. The absolute move is so big, he said, that one should expect an expansion of the bid-ask spread. He didn't come off to me, Steve, as
it being a liquidity.
All that surprised, I would say. Not that he's not concerned, but he wasn't all that surprised, just given what we're seeing. He said, on stresses in the credit market, he said, these things are kind of shockingly orderly. He said, even investment-grade corporate market is pretty orderly. Given that every single market is down big and the Treasury market is up big, given that context, the credit market is more orderly than you might otherwise expect. Okay, just because of what you're witnessing across the board in the markets. I said, well, how bad could it get? How concerned are you? He said, well, I am concerned. Things have to get worse, he said. You don't have a move like this end without disorder. It just never happens. That's what he said. In terms of what the Fed may do, he said, these calls for more Fed action seem early to me. The stock market isn't even down 20% from its high.
Okay.
So you can address those in any form of fashion.
Counter that with what I heard this morning from somebody at a major investment bank who told me that the ability of Japanese banks to swap into dollar assets, and they do this cross-currency thing, was 30 basis points. It's now 120 basis points. Things with Europe were like 5 or 10, and now they're like 30.
And he doesn't he doesn't dismiss that, or he not at all. And he to your point earlier about opening up these swap lines, that was sort of met by Gunlock to me of well, of course, sure, I could see that, but that
you can tell Jeff to rest easy because I checked with the Federal Reserve. Those swap lines are actually open. They were converted from temporary to standing facilities. So if Europe or Japan want to borrow in the dollar swap line, they may do so pretty much at their leisure.
I mean, I think the bottom line here is that while he's concerned about some things he's seeing in the credit market, it hasn't reached DEFCON 5, if that's the highest, or DEFCON 1, whichever way it is. I can't remember for watching war games. Whatever level that is that marks the highest point of stress and concern, we're not there yet, but goes on to say that you never have a situation like this end in anything but. It's just a matter of what ultimately gets you there, whether it's the stock market having that whoosh, which when, we sit here and we watch the market today and a 7 or 8% move feels like a whoosh. Feels like a whoosh. That's not what he was talking about. You could get a 15% move in a day, which is the ultimate thing that puts you in a place of real fear and worry.
Let me respond with what I think the Fed would care about. Stocks falling, not really a big deal. Yields falling, not really a big deal. What they care about are people who are leveraged into all of those trades. And those people losing money is not really a big deal. I think their biggest concern is, does it create systemic risk? Do we find out ex post that the risk that we thought was not in the banking system is in the banking system? There's no indication of that right now. In fact, banks acting to preserve themselves makes the situation worse in the sense that they keep dollar funding from the market. So they husband those resources because they're either because of regulatory reasons or their own concerns and their own models tell them, hold on to this stuff, don't provide it. That's how you get to that place where there's a real concern. And I agree, we are not there. What I have heard is market participants telling me there are some dislocations out there. There are some indications of some of these things that we saw back in 08 and 09, but not on that extent. And we are not yet, there's no information, and I hope it's not true, and I don't think it is true, that the risk is going to be found to be lying back in the regulated banking system.
Let me ask Guy a final question here to go back to a lot of the points that you were making, and with the context now from Jeff Gunlock about what he kind of is or isn't worried about out there. Is there anything that somebody could step up today and do or say that would make you feel like, hey, my concerns are being addressed about this market. We're going back to the good old days, not the bad old days, that sort of thing.
That's a great question. So I'm 56 years old, and when I was a kid, there was a great commercial. That's it. I appreciate that. If I'll dye my hair, I'd look a lot younger. But there was a commercial, it's not nice to fool with Mother Nature. And what's the point? That's exactly what's been going on. Let this system, let it run its course. Let things happen. It's painful. I get it. But again, you don't need... I don't think it's about where rates are. It's about liquidity, right? So you can drop rates as much as you want, but I don't think that's helping the problem. To me, it's just making it worse. To Steve's point, yes, I understand the Fed didn't want to create that, but that's exactly what they created in terms of leverage. And I would say one other thing, and I know I'm going to get added at on Twitter. I don't think the problems from 08, 09 were ever solved. They just got moved, and they got moved from banks' balance sheets, which are probably looking pretty good right now, to Steve's point, to the balance sheets of central banks, which are totally inequipped to handle. And last point, and I don't think the Fed thought this through as well way back when.
Guy, I got to interrupt you. There's just no evidence.
Well, there is no. It's
that
an
the
opinion.
problems were moved
Steve,
to the. No.
Opinion.
But there has to be some basis.
Yeah.
To
Well,
it.
look at the expansion.
How is it possible for you to say that the problems from 08, 09 got moved to central bank balance sheets?
Where'd they go? They just vanished. They got better.
No. I thought you were going to say what actually did happen, which is they got moved.
Come on.
Let me finish. They got moved outside of the banking system, into the non-financial, into the non-banking system, into the shadow banking system. That's precisely where they were drawn, and that's precisely a question that we have about the extent to which the risk is there right now.
No,
but I don't see how they were on the central bank balance sheets.
Well, we got to go to commercial. I know. I mean, just look at the expansion. Our Federal Reserve balance sheet expanded at a ridiculous pace. I don't think that's in any way healthy. But again, we can agree to disagree. These are just opinions. I'm not trying to state fact other than the fact that in terms of vol and what's happening in terms of derivative books, I think. And if you want to bottom, if you want to know when this thing is going to end, my opinion, it's when you walk in one day and say some derivative book somewhere absolutely blew up. Then I think you're going to have at least somewhat close to a bottom. Until then, I think this thing continues.
And you're sticking around. We're not going to any commercial breaks, so don't worry about that. Scott, thank you very much.
Yeah.
Steve, we appreciate it.
Steve, you asked me, well, I wonder what Gundlach's thinking, so now we know.
Now we know.
Appreciate that, Scott.
Stocks are hitting session lows in just the last couple of minutes. With an unprecedented drop, the major averages are now down about 19% from their record highs just last month. The question is whether this puts the end of the 11-year bull market within reach. And on that note, let's bring in David Kelly. He's Chief Global Strategist with JP Morgan Asset Management. And Russ Kosterich is Portfolio Manager with BlackRock's Global Allocation Fund. David, let me just start with you. You're probably champing at the bit to jump in here on the central bank debate. What do you think the main problem is with the markets today?
Well, I think it's uncertainty actually about the economy, which we're not really talking enough about. But I think what really happened is as these numbers of cases have increased, people realize that more and more companies, more and more individuals are changing their behavior. That's causing social distancing. And if you look at the numbers on consumer spending, you can easily sort of put a hit into hotels, airlines, restaurants, and so forth. And you can easily come up with a recession which starts in the second quarter. And I think that's really where the problem is. But for investors, just calm down. Markets are crazy in the short run. In the long run, they are dictated by economic fundamentals. We may have a recession, but we've seen a big fall in stock prices to date anyway. And if we have a recession, eventually the coronavirus itself, its effects will fade. I think the effects will be very, very big around the world before we're done, but they will fade. Then the economy will come back. And so I think people should look at valuations carefully, make sure they're appropriately diversified, but just don't get too focused in these short-term market moves. They may be saying something, but I do believe that central banks can deal with the financial stuff here. It's really the economic stuff we've got to worry about, and there's some limit to the downside there.
So, Russ, what is, in your view, the economic risk here? Have we even begun to see it?
The economic risk is real. I mean, we're seeing this as a very unique economic shock for a variety of reasons. One, it truly is global. Second of all, it impacts both the supply and, as David just mentioned, the demand, and it is very hard to quantify. And for all those reasons, I think people are understandably concerned about the economy. Most people came into 2020 with the view that the global economy, while not great, was stabilizing. This certainly changes that narrative very quickly. And it's not inconceivable that you could have a quarter or two of a contraction. But I do agree with David. I think that the risk here is about how much the economic environment changes. What does that do for earnings? And how, if at all, can policymakers respond? I mean, so far, we've seen from central banks, I think there are legitimate issues about liquidity. But really the key here, other than a deceleration in new cases, is going to come from the fiscal side and targeted actions that help both individuals and companies that are made vulnerable by this shock.
David, on that note, we know that now that we're going to have Wall Street execs at the White House tomorrow. Yep. Of course, I think this evening Eamon Jefferson reported that Trump's advisors may be presenting him with some fiscal options. What would you like to see announced?
Well, a few things. First of all, I think we need to give the effective medical insurance against this disease to everybody. I mean, I don't know how you do that through an expansion of Medicaid, or maybe you just find some other way of funding it. But I think anybody who wants to get a test should be able to get a test. People should be able to deal with it. So we need to deal with short-term the medical issue. Second of all, I think we need to look at the businesses that are being impacted, particularly small and medium businesses. Think about small business administration loans. Think about helping companies weather the storm. And third, we need to think about the low-income workers, because a lot of the workers in the service sector are low-income workers who will be hit by this. Can we do some sort of stimulus check or something, maybe $1,000 per person or per household or something, but just a very egalitarian kind of tax cut, which really helps lower-income people to give those consumers some money to get by if, unfortunately, they do lose a job or lose hours because of this. So I think that's what you need to do. You need to protect small companies, protect vulnerable individuals, make sure you're dealing with the healthcare aspect of this. I think that's the best you can do in terms of helping right out the storm.
Okay, we're coming up to the oil close, guys. Got to run. David Kelly, Russ Kostrich, thank you for your thoughts today, and we'll see what we do here from the White House. But as we hit half past, today's market sell-off has been triggered by a huge drop in the price of oil.
Woo! Headed down some more, guys. Crazy. Woo! Crazy. 274. We could break new lows. This is crazy, guys. Wow. Huge drop in the price of oil. So hey, guys, there might be a move here.
Dow 477? No way. Yeah, we're at 187 million. We got an hour and a half left too. So let's see.
Yeah, let's see where it goes
See
here.
how low they take it.
Definitely buying some TLT for protection here.
Oil through 31, good call. I keep that. Yeah, a 30. That's a 30 handle. Remember I said right when it hits 30 handle, it'll trip. Get ready. We have to see how much harder it fluctuates. Oil should be closed right now too. The AMDs are back up a percent. The Bob. Let me see what we can pick up here.
Excuse me, from recent highs.
David, what do you think about how this will ripple across
Oh,
the energy sector?
Lord, I don't want to go
Last week,
crazy.
a lot of the stocks were already trading like oil.
Not trying to go crazy, but I see some place.
Yeah, me too. I can't wait till this shows us where we're gonna.
I want me a YOLO.
Yeah, my Bollinger Bands and all that fun stuff.
No.
But ultimately,
I'm
it's
sorry.
not unexpected in
I
a
mean,
way,
I'm just
because
trying
since
to
2016,
sing it out of me.
they've made an artificial cut.
Don't sing?
Drop in their economic interest.
Don't
And I
sing?
think what we may be seeing on the equity side, which is taking a
Tell me
long-term view on
what to
the
do,
sector,
okay? I'm very
is
scarred
ultimately
as
we may
a
be
child, born in a
unwinding
very
this
strict Middle
economic
Eastern family.
Think of it that way.
So
Since
I get triggered when people
2016,
tell me what to
OPEC
do
and
like
shale
that. Don't
production
tell
is
me what to
down
do. You ain't my
4.4
mama,
million barrels per day.
okay?
The rest is
Inta
up
mish mama, inta
5.5%.
mish baba.
At $60 oil
Iskut.
prices, that's
And mish
still a
ice
$1
kalam,
billion
habibi.
wealth transfer every year
Iskut.
from one sector to the other. So I think what the market is saying is, are we finally moving back
Oh,
to
come
more of
on,
a rational
studies.
market structure?
Bro, they're
Low-cost
coming back in. They're
producers,
supporting
namely
this,
Saudi,
man.
Russia, growing
Yeah,
production
this market, I think it might be time to pick up some calls.
indeed do
That
not
might be
businesses simply not having to be around for the next
the
2
move
years.
here.
If it goes back to
Let's see
Russia
how
and
it
some
plays.
of
It's
their
gonna test
low-cost
this bottom
producers,
here.
sure, absolutely.
This is
But
it.
they have high break-evens for their budgets, do they not? So sure, even if that wealth transfer goes back, they come out ahead. U.S. shale production goes down, and oil's where still $40 a barrel. I mean, doesn't that still hurt their finances?
So in the short term, that's always the case. It's always better off to cut production to support pricing for both economies. Although Russia's break-even is $45, whereas Saudi's is somewhere between 80 and
8% on the
85.
Dow,
The key though
7.5
is
on the
let's look
SPY.
3 years from now, right? If they do manage to increase production and prices recover from here, maybe it's not 60, but even if it's 50, 55, by then both economies are better off, right? Saudi's fiscal deficit
is at least half as small by 2022 than in this kind of flat production, stable price environment. So that's why, there are long-term economic benefit to doing this market.
Just watch out, play. Yo, this is the moment of truth right here.
The moment of
Do a
truth.
mini little bounce and come back here.
Let's
It's gonna
see.
just wet butter through it right away, and then
No,
we'll
this
see
is
where
the
it's gonna
low.
be a big bounce.
27. The 27.
Every single
273.50
scenario that could happen.
is that's our double bounce right there. That's our area to watch right there.
Able to stream alerts. First link in the description, but you must watch
Get
said
back
video.
to TLT
If you do
here.
not watch that video, you will be in trouble. You will not be allowed to sign up. So we encourage that you watch this stream for probably a month to determine if stream alerts will be a perfect fit for you. Otherwise, it's probably not. You can get it here for free. Just pay attention to the live stream. We're live Monday through Friday, 30 minutes before open. Drop a thumbs up on the video. Second link for the nightly watch the main channel. First link for the stream alert bootcamp and real
Woo!
estate.
Listen to him freaking go on his fast rant. I'm trying to get you guys the bottom here. I think it we'll see how it closes here. We got an hour. Oh shit.
Justice therapist here to help you guys out. Just because there's a lot of stress and panic in the market. Make sure you guys are breathing deep. Feels really good. So you guys are relaxed. Keep that, drop the shoulders and all that. If you need someone to talk to, we understand. And you familiarize yourself. Make sure you're on the watch list. But make sure you guys are cool. Just wanted to check in with you.
Yeah, make sure you're cool, everybody.
You're here. Yeah, you're special. You're beautiful. Enjoy life. Okay. I'll check in on you. You guys need me? I got you. Okay. See you later. Bye-bye.
Watching important levels here, guys.
Okay. Hey. I hear you guys in the chat. You asking for Pony Montana? Okay, you got me. Now what? What you want to talk about, huh? You want to type and spam my chat? Saying bring the Pony Montana. Okay, now you got Pony Montana. What you want, huh? Now you think they can help me? You think they're gonna help me? I've been down 20%. They didn't help my account. I've been down 50%. They didn't help my account. You think a halt gonna stop me? Okay.
Nobody's gonna halt us, are they? I don't think so.
It's fine. It's how you bounce back.
It's always how you bounce back. We gotta bounce back, everybody.
Got me now. Here, I gotta focus on the mark. Look at this. We're breaking through, man. 7%. It's crazy, man. Where they do that at?
Damn, we are getting there, guys.
Crazy, man.
Here we go. Getting closer.
Okay, I'll see you later.
We're getting so close.
Yo, get back there.
Man.
People, I don't know how to keep them entertained. They just make fun of me, say Pony Montana. I don't know, man. Get back here. You're stupid. Hey, guys. Sorry, I had to go to the bathroom. I let them take over. No Cardinal yet. I got UNH. We're waiting. And again, I'm gonna wait for a big bounce to just finesse these premiums. I hope you guys are ready for that. So do not force it. Don't you force it.
Crude itself is about 14. But what would it be in a few years? So, shale I don't think is going away, right? We're not making the case that this is the end of shale. Even if Saudi, Russia increase
streaming my live, email me.
Let's do it. Let's do it. Come on, let's get in here.
We are a very fun cult. All we ask is you're positive and respectful.
Yes.
And you, think for yourself. We're a friendly cult. We believe in just friendliness.
Well, that's how I am too. I'm so happy. Come on now. We gotta have. Here we are. Here's the bounce, guys. Here's the bounce I'm talking about. This is the bounce area. The bounce. The bounce.
So watch how it plays here at the bounce.
This is my bounce. You don't take my bounce yet. You can't take my bounce. I called that bounce.
The same assets can be in the hands of lower cost producers. So I think we're away from 1 million barrels per day growth every year unless the global market demands it. But at the same time, this is not perpetual declines from here from a shale perspective. Can we give a shout out, by the way, to Al Walker? Al Walker was the CEO of Anadarko.
Remember the days when 11 out of 11s were one-on-ones? They still exist. I mean, it's just a different time here in the market.
So Al, if you're out there watching CNBC, you're either the luckiest or the smartest guy in the world. Congratulations.
Probably take it either way. Brian, thanks very much. Damien, we appreciate it as well. Damien Corvalin joining us from Goldman.
All right, the Dow tanks more than 2,000 points amid growing concerns about a global slowdown.
Is TLT halted? No, TLT's not.
No.
The worst is yet to come.
I mean, they can halt bonds like a limit up, but no.
A distinct possibility for both the United States and Europe.
Yes, tradingfraternity@gmail.com is the email.
I hope it goes all right. I can't wait.
The bottom players, those are getting clapped, right? Yeah, those are down 16%. The AMD barely getting.
Oh, let's go back and look at this. Let's go back and look at that. What I was just looking at here.
Yeah, I'm still holding the EEM puts.
Ooh, look at those.
Surprisingly,
Those
aren't up
calls.
as much. I mean, what?
Calls are gonna get going here.
I don't think the Robinhood's updating on them. Unfortunately, I got 35 puts.
They were at 202.
At 50 cents.
Looking at about 217, 215 now. These could double here in the next couple days, especially if.
100 something. We just put a lot of money into them.
Man, there's just so many people saying negative bullshit on them, on the. In regards to the market, like this is.
Yeah, you see.
This
so
is
market
usually
was
the
trying
bottom.
to just pay attention to the yen, but then also oil too if that comes down.
I don't know about oil.
The UNH, yeah, those are still in play, but they went up a lot. But that play, I mean, you could give that one time. We're gonna come back to that. We'll find a way to get it.
Yeah, we can figure this out here.
You know, sir, respectfully, you mentioned the health of the consumer. You know, I push back and say, you know, consumer debt to GDP is at levels we probably haven't seen.
Dude, yeah, it's starting to get volatile. This is looking like the limit down on futures, where you have a force here. They're stopping it, but it's bouncing up and coming. I mean, dude, they're trying to hold this really, bro. We're down 2,000 points. This is still gonna get crazy.
Yeah, it is.
They confuse the health of the consumer with their want to spend. The two are mutually exclusive. I never underestimate the U.S. consumer's want to spend. I'm not certain, though, at this time they should.
Come on.
Yeah, that's right. I mean, we live at a time of.
Let's get a little bit better here. What are these guys? Oh, these guys just talking about the coronavirus.
Cardinal has hospitals too. I want to go for insurance companies. That's my next biggest thesis to go. If it loses,
oh, here we go, guys. Here we go, guys. Let's get back to the chart.
However, the fact that there's so much support, they might let it come down below and start walking it down little by little.
Yeah, they might have to, huh?
You can trade with any amount of money. It's all about setting the plan. That's what we did with the small Robinhood. I might need to show you guys that thing. But you put $100 a month, $100 into a long term, $100 into options, and then just go little by little because you're going to blow up an account. There's nothing to do with how much you start with and then finish and I'm out. No, it's just staying in the game.
Staying in the game. We got this, everybody. We're going to be.
Well, it's
we're
riding
on
the plan.
this.
We made a few plays so far, but other than that, the plan is riding the wave down with what we have, and as it bounces, we need to come back into it.
In the recession scenario that you foresee.
274.13. Look at it. It's slowly coming down here, but I mean, it should be cracking really heavy right now. We're almost at 200 million in volume. Yes, TLT can still tank again. Any of those bond announcements. There was that old thing the first time, but we haven't. I'm pretty certain that's how they're going.
I'm curious, as a data-driven individual, what your reaction
is. Oh, here we are.
30.90.
Here we are.
The lowest fat figure was
273.
Watch out.
273, something 75. Here we go, guys. Here we go.
Look at the low ticker. This is going to get wild here. The party might not even be able to keep up with it. You might see this.
No, yeah, this might. It's either gonna. I mean, this is a really key point right here. We have never seen this go down this far and this fast. I can't believe this right now.
Yeah, everything's gonna start. Watch out, that's what they're gonna do. Because again, if it falls below 7%, I mean, it's not that far from 13.
We're already seeing the demand
it's
destruction
really
in
not.
services. We've seen it in China. We are seeing it in Japan. We are seeing it in Korea. And we are starting to see it in Europe. So I think it's very clear if you look around the world that this is a very sharp downturn. Again, it can be
temporary, it can be relatively short because there's nothing wrong with the underlying health of balance sheets, particularly in the consumer sector. But I think this will only arrive in the hard data,
Here we
particularly
go.
here in the US, in the next several weeks and months.
Mr. Fells, thank you very much for your
Coming
time
down
today. We appreciate your insight.
27,360.
Joachim Fells of PIMCO.
We're closely watching the yield on the 10-year note, which is back down around probably under 0.5% now because stocks are at session lows once again. You see the Dow down about 8.1%. There's a 10-year
8.1%, guys. All right. So we broke that there by 5 cents there for a second.
Look at Citi
Yeah, 15 hours of power hour.
So we will see here. Sometimes we'll break it by like a couple pennies and then it'll bounce back too. Like double bottoms don't actually have to be double bottoms, guys. Like this doesn't actually have to be at the same exact price. It's just got to be really close because you think about all the computers trading and the time delays and stuff. Sometimes the computers become a little bit off, you know, a couple percent there and millipercents that is. And that's where we're going right now.
Yeah, Boeing, dude, Boeing got clobbered.
Ooh, yeah, Boeing is getting, all these guys are getting clobbered.
Coming down now, 273.70. Watch out, big volume right there. See how this holds up. We're down, we're about to hit 8% on the SPY, bro.
Wow.
Crazy, crazy, crazy.
Oh, I'll be right back, guys. Hey there. Good, how are you?
It's coin flip time. All right. I had an idea. Coin confirmed it. I love the coin. Me and this coin work together really well. God is good. Okay. I made a move. I made a move, and I'm excited about this move, baby. Cautious. Now I still have to happen it. So, the ghetto. I shorted the TLTs. Oh fuck yeah, baby! I shorted the TLT May 190 contracts at 760. I collected over $14,000 on that trade, and we still have an upside. And now I have fully revived the Tastyworks account to a substantial gain now, baby. To a substantial gain, baby. Woo! All the cash back. That Apple trade couldn't bring us down. Oh, thank God. That's it. That account is now fully revived to a whole crazy level. I don't think y'all feel me on that. Oh, you guys have witnessed this thing, baby. Oh, I finessed the cash is looking good too. Take a look. This account's at 56. This was at 10 grand last week. We got all the cash back now. I have 43,000 in cash. Net liquidating 56. That's it. I mean, we did it. We did it. I still got these. These were the TLTs. 400 into 18,000. Then I just shorted these. We're done. That's it. Now Now we have the other account. I'm still riding out the Robinhood. So the play was a taking profits play. So I ghetto spreaded it. We own these. So look at, I have a 99% probability. Same thing we did with the IWM. We did it, baby. God is good, baby. I'm only flexing. If I'm flexing anything, it's the power of the Lord to resurrect, baby. That's what it is. It took a little patience and it took a little hope, baby. Just stay in the game. Don't quit. Praise God. That's all you got to do. Show love. That's all we need, baby. That's all we need. Mike Tyson. I don't like that Mike Tyson. We already have a Mike Tyson. So you're gone. Okay? You just said something. I don't even know what you said, if it was positive or negative. It just sounded negative. And I didn't like the Mike Tyson face. And I was like, we already got a Mike Tyson in here. So, sub. Should we hold? Well, I ghetto spreaded them, so I still have upside on them. But I closed out of them. Let me see the other ones. What's the difference on the first ghetto spread? 170 to 179. As the April ghetto spread on TLT, we made an additional $14,000 on it, so we could take 14,000 of the 30,000 max profit on there. Because it's already almost at 179. And then the Junes I haven't touched yet, so the Junes we still have $20,000 in June plays. That's why I want to take profits on the other ones, because now the June one is just, that one's just insanity. Bro, I'm so happy that Tasty account, man. I can't believe that. Let me see. I'm going to do another coin flip. We'll see what it says. Heads go ahead and hold. Tails fall back and sell. Oh, wow. Okay. Okay. So I'm probably going to get ready to close out the ghetto spread on the other one. On the Aprils, because I have half of the max gain. So this is our, why dude, it's showing me different values. That's $245 into 48,000. Wow. Very nice. So actually, here's how you would close it out on the ghetto spread, you guys. You come April, but I'm not closing it out just yet. I'm showing you. I'm going to watch the prices and see. You buy back the ones you sold, then you sell the ones you own, and then it's all about the price that you get a credit at, and then that's it. You lower the price to get filled faster, but then you receive less money. So that's what Get ready to sell that. Winning or losing, you showed the same amount of positivity. That's crazy. Amen, baby. Isn't that crazy? Everybody's looking at the play, this and that. That's a valuable insight you just took from that. Let's see. Shit. Why did this shit work? Yeah, my values are all screwed up. Oh, we got 3 more minutes till power hour. Oof. Oof. Ugly Phil. God damn it, Phil. Okay. We did it, baby. I closed out that beautiful TLT play. The April, I closed out of all of them at $33.60. Got me about like $13,000 in profit extra. We finally closed it out. That's it. I mean, that play that would have been $500 into 100,000, but we walked away with like 500 into about 40,000. So not too bad, not too bad. Because remember, we collected premium too, so it wasn't that bad. It wasn't that bad. That was crazy.
Woo! What was crazy? Sorry, I missed it. What are we seeing? Oh, look at that. Oil and gas popping.
Drop your thumbs up on the video. Make sure to subscribe if you don't know.
What are we doing? TLT.
Friday, 30 minutes before open.
TLT is dropping.
Video.
What is going on here?
65 in cash. Oh, thank you. Second link in the description. Nightly watch.
What are we doing here?
First link for the Scream Alert Boot Camp and real estate course. It's not loading up. I'll be right back though. Hold it down. Keep it positive, respectful. I appreciate it.
Keep it positive. Keep it respectful. Everybody. We love you, everybody. Thank you, everyone, for joining me, by the way. I really do appreciate y'all. You guys are always great. Even if it's just one of you that are watching live. I always like to try to do these videos during the market live so that you guys all can see what is going on. You guys can tune in. You guys can watch a little bit of CNBC over here. Get a little pumped up on the market. Oh, man. Woo! Look at these. Look at these.
Monetary policy. So I'm optimistic. You asked the question about where could earnings end up. Here's a quick back of the envelope calculation. Last year's earning 163. Right now projected to be up about 7%. Probably overstated. Let's cut that down by 10%. So plus 7 becomes minus 3, 163 becomes 160. Next year we have an optimistic or conservative 8% rise. Once this blows over, you apply a multiple of 60 to those forward earnings, which is where the market has consistently found a floor. You're right at these levels of 2,700, 28.
What if earnings fall 20%?
Of course, then it's a different story. But the U.S. economy, last year's GDP 2.3, composite PMI at 55 suggesting 2.5.
All right, guys, here we are. The market is doing the same stuff as it always does. Goes up, goes down. We are trying to make the most out of it. Let's pause these guys over there. Stocks are plunging. We see that, everybody. We see that stocks are absolutely plunging. They are currently also at lows too, so I want to show everybody that. Actually, they're off of lows. I'm sorry.
2 years in a row on TLT. Oh, they said it was luck. I said it was econ, baby. Said it's econ. Ooh. The fact that I'm getting teeth, man. Woo. They said gambling with $200. So this is what I want you guys to take away from this now.
Let's go back over here.
All of your accounts are inflated. If you're in any of these plays, pay attention. The key is the cash. Remember that. So think about that. I took all that money. I just took another 13 grand. We're at 52. Now it's at 65. Your cash is where everything needs to go. That is the key. So it doesn't matter what this says, because if the market bounces and you drop, assume everything is going to go to zero. Because if everything goes to zero, I'm still going to walk away with 65K. We still pretty much double up the account. So keep that in mind. Same thing with the Tasty Works. This is why I was so excited for this one, because now my cash is at 43,000. So it doesn't matter. That's saying net liquidating is 56, but now we're at 43. So it's all about getting the cash, my friends. All about getting the cash. And then I'll show you. Let me pull up the small account for you guys. Is it window capture? Yeah. The random account, we haven't done any of the plays in this last 2 weeks. I think it's just been a little bit too crazy for that. All the Mays are ghettoed.
Woo! Here we go.
Is the IRS gonna come knocking with a why? I'm just gonna report it and pay them. What y'all say this? What y'all think this is, man? That crazy. Pay your taxes, baby. That's why I tell y'all to get your taxes ready.
Oh, this has got to be a moment for these people to get more stocks, right?
All right, and then here's your small account, ladies and gentlemen. Same logic with the small account. I want you to pay attention. If you're not learning this, then yes. If you're not paying attention to this, you will get clapped.
Clap, 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 clap your hands, clap your
50%
hands.
today. It is hitting all kinds
And
of
this has to do with how much money you start with.
just across the
We're at
board.
38,
And natural gas
85
actually
on
up a
here,
little bit. I'm
but
thinking the reason that is
the
because
best
the idea
part.
is that if we start to slow production, either organically, companies decide they're not going to produce more oil, or
2,000 in cash in
inorganically,
here.
they simply run out of money and
That
go
is
out of
the
business,
key.
that we will also produce then less
You need
gas.
to
Because
have the
remember,
cash,
natural
otherwise
gas
it
is a
doesn't mean
natural
anything.
byproduct
So
of
in
drilling
this
for oil.
case,
You already had a name
all
like
of the
Diamondback
cash is
Energy, the
secured,
original
even
fan,
if I go
come
and
out and
lose
say it is
every
slowing
single
down
play I'm
crew
holding.
completions, going to
It
slow down
doesn't
well
matter.
completions, guys.
I mean, at
Everybody
that
I
point, I'm
talk to
still going to
expects
walk
a
away with,
lot more of
we'll
that
be
type
right
of
back
stuff.
up here.
Remember,
We're
oil,
still up
not really an oil story.
216%
It's a job
over
story,
time.
and it's a debt
And this is
story.
what happened.
And we'll have more on the story, by the way, at 5 o'clock on Fast Money. Back to you.
Brian Sullivan, thank you so much for that. Now, bank stocks also getting absolutely slammed today. The strong correlation when panic is in the air with what yields are doing very much at play. Why, of course, banks make a lot of money based on where the yield curve is. Here is exposure for the banks to net interest income. Citi, the highest, though Bank of America often seen as the most interest rate sensitive because of its high consumer exposure. And indeed, Bank of America was down 37% from its intraday February peak to its intraday trough today. Add to that the fears of exposure to the energy market that Brian was just talking about, and you have a perfect storm today for the banks. But here is loan exposure to energy for the big banks. Fairly low, though some small regionals will need to watch out for. Cadence, Bank 7 and BOK, some of the names with the highest exposure to energy, and accordingly, those stocks down sharply today. Indeed, unlike energy companies, bank stocks are still above their 2016 lows, which was the last time markets have feared a sort of rates are never going to rise again, or oil prices are tanking type environment, and that might suggest more downside. On the flip side, they're a lot cheaper today in relative terms, whether that's P's or P price-to-book ratios or dividend yields. Last week, Autonomous estimated bank stocks were pricing in a 50% chance of a recession. Clearly, that number today higher still. Here are their dividend yields, much higher than in 2016 at the lows, when the dividend yield for the group was about 2.5%. One other comparison that's being made is versus 2008. Two big differences. Capital liquidity so much stronger at today, and the epicenter of this crisis is not financial, and therefore clearly a big difference nonetheless. Can expect more downside if yields or oil prices keep sliding.
Can you touch either of these groups, energy or banks? That is amazing. I love you all, man. Thank you all for watching. Thank you for being here. Thank you for holding it down. Don't worry. We ain't gonna go Hollywood on you. I remember all the people here from day one. You guys still make it amazing. So thank you all, man.
At the meeting next week after the emergency 50 basis point cut.
I don't even want to look
Last
at
week,
it. Oh,
with
six.
energy prices,
God bless
it's a
y'all,
price
man.
war
That's
out
crazy.
there, and we don't know where it's going to stop. We know the
Crazy.
26
I'll throw a $6,000 play tomorrow.
WTI in
How about that?
2016.
Maybe whatever the lights end up at,
Let's
I'll
go over
play
to
that
Mike
side
Santoro for a
once
look
the
at
premium
market
settle.
trends in the
Fair enough?
S&P. What are you watching,
I think
Mike?
that's fair enough.
Let's try to
I
frame
love you
this.
all.
I mean,
I
when we go
appreciate
down in
you all.
price, we
I
also
hope
go
you guys
back in
got to
time. So
enjoy
take
this
a look
all.
at a 3-year chart of the
Thank
S&P
you.
500. We were talking
You
late
guys are
last
great.
week
I mean,
about the
this is
chance that maybe the S&P had to retest the intraday lows from a week ago, Friday was around 28.55. We sliced right through, of course, simply because of that oil price trapdoor. So here we are. What I find interesting, before I get to where we go back to,
that's going to be our next play.
27.40 was a level people were looking for well before today.
Once the premium settles down, I can't do it right now.
Last year. It's also
It's a little too
some sort of
crazy here.
technical retracement
So I love you guys. I
of the
really
whole
do
rally
appreciate
from
you. This is
2018.
amazing, man.
But this brings us
This is
back, as I
crazy.
said, to
I
early
don't even give a shit about the
2019.
money.
What I also find fascinating is
That
these
is
are
fucked
levels
up.
that
I
we
know. You
first
guys
hit
be like, well, I
in
want the money.
January of
No, how are
2018.
you
So we're
saying
going
that?
back 26
I just love you guys,
before,
man. This is
when we
unity,
first
man.
got
To
these
have this
levels.
many
So
people
clearly
here
a
and
lot
to be
of
sharing
stretching
this
to the
in
downside.
history. Come on, man. This is
Washout
beautiful,
conditions
baby.
across the
That's
market
why I
right
throw
now. We were
7K at it.
oversold a
What do you
little bit
mean? You
last
guys
week.
see, I throw the
Now
money.
getting
So
to be
this, everybody here
extreme oversold. I also
participating
want to get a
in the
longer term
game.
look. Today, we handicapped it
It's
last week as the
beautiful.
11th anniversary of the bear market bottom, March 9th of
I just
2009.
want
And
you
so
to
this shows you
know
the entire
you're my
length of it.
favorite
What I find interesting, by the way, if we get to about 27.08, I think it is, 27.07, it's a 20% drop. We
I
closed
just
there.
want
We
you
can
to
finally
know
say
you're
on a
my
technical, statistical
favorite
basis, it's over. But I think, so I told you, we went back to 2018 right there. Look at the previous times we've done something like that.
We got
We've
50
kind of
minutes
gone back
left.
about
year and a half or so
I love it
to
making
where we
these
first got to these
exchange
levels. So
sport,
it's not
baby. Of course,
unusual.
we
What
passed
is
the ball.
unusual
You
is
remember
how
right? That's
fast
why
we
you guys
poured,
did
we
too.
surged
Shout out
above,
that
and then
UNH
gave it
today.
all
Whoever
up right
passed
now.
the
So
ball, let's
clearly,
go,
it's
baby.
still a treacherous
That's
situation,
how you
just
get the
looking at a lot of
defense. Just keep the
the
ball
intermarket
moving.
stuff, the volatility
Keep the ball
indexes, and
moving,
the
baby.
credit
Keep the
market.
ball
Mike, it
moving.
seemed
That's it.
earlier in the session like
That's
the
all we
circuit
gotta
breaker
do.
helped because after we reopened, we were more like 4 or 5% down on the day. Now testing the 7% level again. Well, what do you make of whether they helped or hindered or what?
It's interesting because the index futures, as we know, pre-market, they're limited to a 5% loss. The ETFs, based on the indexes, were indicating a 6 or so % loss. My read on that was, if you're down 6 1/4 on the ETFs, you're testing that circuit breaker. There's almost no way you're not going to touch it because you're so close to it. Then once we did, we had a lot of purging of stocks on the open. A Monday open, you have a lot of Mondays where you have down 3 or 5% days. It's the most frequent day to have a big loss, and to me, you've got a lot of it out of the way. And I think the fact we were down 12% coming into today is part of that reason. Also, yields did actually bottom overnight, so that
What is it about Mondays?
you have all weekend to think about it, I think.
So, Lindsay, I mean, what stands out is the
Well, no, that's just
speed
the
at
nature of
which
the
we have
spread.
erased
So if you
just
could
what,
close it for
almost
like
2 years
800,
of
it might be
rally?
worth it. Otherwise,
Yeah,
you
what
take
does
the
that tell
risk
you how fast it's
for the
happening?
other sold
Well,
contracts to lose value.
the speed is definitely breathtaking for sure, but it also means that we can bounce back much quicker too. What we have historically seen is it takes normally about 5 months to get to correction territory, and then you get five months later you're back to where you were.
This is what, 2 weeks?
Yeah. So I think that we can potentially see it happen much quicker, but there's no guarantees.
30 grand in
Transport's plunging today along with the broader market. Frank
And I
Holland
got the
has more on the
IWM
action in
puts
that
rocking a
group
little
at the
bit.
NASDAQ today.
As
Frank.
much
Hey there, Sarah. You know, Dow Transport's on pace to close at their lowest level since December of 2008. Rail stocks especially plunging, as this week investors expect to see the impact of lower container ships and overall imports from China, which would, of course, directly hurt rail volumes. J.B. Hunt, the largest container trucker in the U.S., those shares down right around 8%. It gets more than half of its revenue from hauling containers.
So Costco, that's a
Airline
risky one
stocks,
because
they
they're not
continue
down
to be
as
under
much, so
pressure
they
from
can keep
reduced
going
business
down.
and leisure travel. United and American have both lost about half their value since the first U.S. coronavirus case. Delta and JetBlue right around a third. And the major shippers also getting hit today with the broader market. UPS, it gets about 4% of revenue in China and already gave lower Q1 guidance due to coronavirus slowdowns. FedEx gets more than 4% of revenue in China, according to Deutsche Bank estimates. It reports earnings next week that will certainly be a window into the health of the U.S. and the global economy. Back over to you.
Okay, Frank, thanks so much for that. Now, oil prices seeing their biggest one-day decline since the start of the Gulf War on January the 17th, 1991. Oil lost 33%. How far will oil prices drop from where they already are? Joining us, Ed Moore, Citi's Global Head of Commodities Research, and Paul Sankey, Mizuho Managing Director and Oil Analyst. Very good afternoon to you both. Thanks for joining us. Ed, I'll start with you. I mean, extraordinary moves in the oil market. We're currently down 25% on
I think they are thinking the travel ban. They
How
just
much
have
of
to
a
wait.
sort of perfect storm is
If they
this
do the
for
travel
oil
ban,
prices
they'll
at
be
the
able to
moment?
say
Can it still get worse?
they're going
I
to try
think
to
it can get
blame all
worse.
this
What makes
crap
it a
on the
perfect
virus.
storm is that this is the
That would
first
make
real
sense.
crisis in which
But,
we've had a demand shock on the one
I
hand
think they're going
and a
to.
supply
They don't have a huge
oversupply
negative
injected
effect
in
on
the market for political reasons by major producers. So we've never seen that before as a coinciding set of factors. But yes, there's much more downside risk at the moment.
How do you gauge that? Why?
So you look at where demand is going, and then you compare it to where the supply is coming from, and you look at the indicators of where inventory is going to grow. You know, we think now that negative growth territory is where we are for the world economy as a whole. We're going to see
And again, you guys
negative
know
oil
why they
demand growth.
declare state of emergency,
That number
right?
is an open-ended number. We're pretty
Again,
sure it's
even
going to be
Florida
negative year
declared
on
a
year, but
state
we
of
don't know
emergency
how far negative.
prior
Let's assume that
to even
we
having
have
a
something
case
in the U.S.
confirmed.
and Europe that
They do
is
state of
similar to what we
emergencies
have
to
in
qualify
Korea,
for the
Italy,
funding.
and China.
So there you go. Yeah, exactly.
We
So
had a big
if you
hit,
don't do a
70%,
state of
maybe even
emergency,
80% at the peak in
you can't
February
unlock the
of
funds that they're
Chinese
approving here.
transportation
So
fuel
there you
demand
go.
was
I'm
lost.
impressed. There you go. Look at
If
you
we
guys,
put that
man.
same number into
Look
the
at that,
OECD
baby.
economies,
That,
that could be a $12
Come
million
on, baby.
day
Chad
loss
all
for
grown
as
up.
much as a
Chad's
month.
smart.
We don't have that figured
Chad
into
knows
balances.
this.
If the
Y'all
market
don't even
sees
need me
that the
at
Saudis
this
and the
point,
Russians are
man.
continuing to
That's
produce
it,
a
man.
lot
Go
more,
do some
and there's
positive in the
another
world. Go
demand shock on
educate
top of
me.
the
That's what
current
I'm
one,
talking
that's
about,
another
Chad,
big
baby.
step lower in terms of prices.
So, Paul, I mean, it is brutal out there if you're an energy company. Marathon Oil right now down 47%. Apache down 46. This is one-day moves. What's going to happen to these companies?
Let's go, Chad.
Well, it's going to be very hard for everyone. As Ed says, we don't really know where we're going, and it just becomes a question of how good their credit is coming into this and how much access to capital they have. And the second thing, which we've been pushing for 2 years now, is they all have to aggressively cut capex. So what we're looking for is the fastest to cut and who cuts the most. And we'd like to see Exxon leading the way there, but we've already had announcements today, for example, from Diamondback, Fang, Parsley. The fastest, best movers are already saying, okay, we're cutting.
Who's in the worst financial shape?
I got y'all covered.
The two bellwethers amongst the high yield would be Chesapeake, that's trading the most today, and amongst the investment grade would be Oxy. They're both really the bellwethers that we're looking at the credit for. The other challenge here, as you know, is that everything is traded by machines these days, so active managers are just on the sidelines, and we're just letting the machines do their thing, which is why you get these extreme moves, because there's no guy standing there with a piece of pen and paper that used to be to control the market.
Well, as machines or individuals, it's quite hard to price a binary outcome risk like a company actually going bust. What percentage chance, let's pick the two you just said, Chesapeake and Oxy, what percentage chance do you put that they go on? Is it a 1% risk or is it a 20% risk?
I think in the case of Chesapeake, it's an extreme danger, frankly. I mean, I don't
More than 50%?
Yeah, I mean, I think I've got to be careful what I say because I don't cover the stock and I wouldn't want to, get ahead of myself there. But it's certainly pricing extreme risk. It has scale still, Chesapeake, in terms of market cap. Still over $1 billion, I think.
I'm telling you,
maybe
my
not
mom
today,
told me
but it was
this
as of last week. So that's why it trades as very much as the bellwether. But you can see that the debt is trading at pennies on the dollar right now.
On the flip side, BP, a major company with a pretty strong balance sheet, was down.
You only need that little of amount, but to truly possess that faith is so small. That's even difficult to acquire. Oh, they don't feel me, huh? Oh, that's mind blowing. It was mind blowing for me when I said that. To even possess that little bit of faith takes a lot. They don't feel me, man. They don't feel me, man. Come on. My boy just texted me. He said there's a source from the trading table. I don't know. Where did he get that? He had to get that from an article. He probably got that from Zero Hedgers. He said Robinhood's getting filled last, source from trading table. But I was like, it don't matter when you're up 20,000%. You know, feel me? You know, feel me? You know what I'm saying? You know what I'm saying? We good, baby. I got fears. I hope you feel me, man. I hope y'all, man. I don't want y'all to cheat yourself out of this. There's gonna be opportunity, a lot of craziness going on right now. It's just wild. So that's it, baby. I hope y'all ready, man. I hope you're ready. But knowledge doesn't require faith. I genuinely laughed at that. What's knowledge going to do? What are you going to do with knowledge? I mean, knowledge is good, but I mean, if you have no faith, you wouldn't even pursue knowledge. What would you apply your knowledge to? You need to believe in something. Faith is persistence. Oh, they don't feel me though, man. Come on, man. Knowledge. I know more about econ and this and that. But shit, if I didn't have a little bit of faith, what would that wouldn't have helped me. Oh, y'all crazy, man. Oh, I mean, faith, hope, love. All of those, always valuable, always intrinsic, always worth anything more in the world. Anything else that's extracurricular. Extracurricular at that point. I'm telling you, man, you're crazy, man. Knowledge ain't gonna save you. Any knowledge of the world, why do you think they sold us the TLT at 7 cents? Knowledge said sell it to us at that little price. Oh, y'all don't feel me. They don't feel me, man. I gotta break it down for y'all. They don't feel me. I don't even want to talk about it. I don't want to get arrogant. I need to stay humble with it. I won't even go there. Okay? All I'm saying, faith is very important. Faith, knowledge is good too. I'm not discounting knowledge, okay? But you gotta put it back and forth, baby. Back and forth. Nah, go there. I don't need to go there. If you know, you know. If you know, you know. That's it, baby. You know, because even with that's what I said. Someone asked me, they said, what did they say? They said, do you feel blessed yesterday? Instantly, I said, no, I feel humbled. That's it. That's all. Like this doesn't mean I know anything or any. It's just a humbling experience to see what I thought I knew, and then see something even come to life, and just operate in a whole different formation and everything. That's it. Quit ranting. Get back to talking about trading details. Uh, well, thank you for signing up for the membership to get clapped. I appreciate that. But that's not what we do here. Because if I didn't rant like this, I don't know if a lot of people would have got the TLTs. Isn't that crazy? It's crazy. So I appreciate your support, but it's better to support with positivity than money. Uh, that's the message of that one right there. It doesn't. I don't care about the money, man. You guys will not. Money will not buy you a good attitude. Money will not buy you positivity. Money will not buy you favor with me or anybody else. That's it. Rule number one, baby.
That's it. That's it. I agree with. You gotta have fun
Somebody
with
do
money,
chat links. I love it all.
but it
And that's why we do chat and take
can't let it ever drive you down,
A
because
lot
it
of
is
people
just
last
money.
here because it's just you're getting in on the hype. You just let people come in. Don't worry. If you're real, you see the value. You'll like it. If not, at the end of the day, there's nothing wrong with you. There's nothing wrong with me. Some people fit differently in different places. You might be around different people. I prefer to be around certain people. That's all. I like positivity. I like respectfulness. I like education. I like, that's what it is. If I'll listen to Charlie Munger talk like this for hours because I could profit off that. But man, I've already profited. I only made 3 plays. We already made the money a long time ago. That's crazy. I guess I'll just.
Look at Walmart still up.
You love this guy, I love you, baby. It's all love. That's it, man. That's game time, baby. That's what I'm talking about. That's all we need. That's crazy. I could take a day. That's crazy, man. That's crazy.
Oh, let's try to add another one here.
Can I give you guys something? Like, honestly, you want to know what's crazy? The day we bought the TLTs, that was February 14th, Valentine's Day. God is love. That's not the main point I was going to say. But what I was going to say, that's when we were going to do the meetup. Think about that. We may not have made the play if we had to deal with 300-400 people flying in, if we had to go do all that. Isn't that kind of crazy? Because remember, we were going to do it for the President's Day weekend.
There we go. That's a little bit better.
Come on, y'all don't feel me, huh?
Y'all
don't feel me.
Much happier with that there.
Like,
Hey, look.
We should have been having the meetup. Y'all would have all been on plane. Y'all would have all not been tuning in. Y'all would have been all talking to each other. Y'all would have been having so much fun spreading Wuhan to each other. Like, oh my God.
Wuhan! Spread the Wuhan!
Damn.
We love that Wuhan.
God's plan, baby. Is that wild? Come on, man. Come on. Don't tell me this ain't divine.
Divine. Looking for a prime. Mortgage top of the line.
So praise. Look at that. You know what I'm saying? Guys, regardless. See, we didn't get to meet up, but I knew it was for some reason. I was bothered by it. I was like, how come this man? That's crazy. I love you. We turn welcome to the call where we turn plays into profit, losses into knowledge. The event time is what changes our perspective and betters our philosophy. Shout out everybody who loves the philosophy, man. God bless you all. Shout out all the people who send a prayer request. Shout out all the people remaining humble. Shout out all the people who didn't get what they thought they wanted, but they still excited and they still know they got more coming to them. Shout out to you, baby. Shout out to you, baby. That's it. I'm telling you, I love you all, man. You guys, I'm telling you, I love it. None of this is possible without you guys. I'm telling you. I don't think I would have made the TLT without a Colt. I really don't think so. And it all led up to all you guys, man. It's exciting. I love you all, man. All the people who embraced the philosophy, who encouraged it, who got the, oh man. And then all the likes too. Don't get me started. Oil after 30 handle. Watch the end. That'll be the next thing. That'll be the next thing to see. I love it, baby. I love it. I love it. I love it. So please be smart, man. If y'all cashed out, and again, so please, if you didn't cash out, I need you to understand. You're next. I got you covered. But now you have to also understand. I need to talk to the people who made money here. This is half the battle. Okay? I'm just telling. I need to make sure the people who make money. You guys remember the story I told you? I turned 2K into $250,000. I didn't walk away with a lot. It was a fucked up situation. I want to make sure you guys are smart about this and prepared and ready to go. So please be smart with the money. And even then, that's why I told you guys. Even I'm telling you, if you're gonna flex, best way to flex is praise God. You know, put your friends on. Don't bring people down. Because one thing you don't want to deal with, and this is why I'm saying I don't care. I'm not saying it for promotion. I mean, it'll help, but you see, we're doing pretty good. And it's because you guys don't want to put that pressure on you. When you show somebody, this is the hardest part about trading live. I'm telling you, when you show somebody what you made, and then now you're gonna have that pressure if something changes. You're adding a third party in there. So be careful, okay? But you guys have to protect this money now. Make sure you take some level of cash and keep that in mind. Do not blow this. Again, we said it. I'm rebuking the period. I'm rebuking the spirit of giving the money back. That's it. Don't. And then I'll tell you now. Don't be impulsive. We said this last time. Don't go buy something. Okay? Don't go buy something just because you cashed out. But that's why they call it new money. Some of you come into money, you don't know how to act. Just give it a few weeks. Don't buy a new trade. Don't buy a new car. Don't even buy a house. No, don't even buy a house. I mean, don't even pay off debt. I'm telling you, just don't be impulsive. You see what I'm saying? The whole idea is the seed is you got a new seed. You have to plant the seed. You planted a seed, it grew something, right? So what do you have to do now? This is a new seed of handling the money. Like, I hope you guys see that. Woo! I hope y'all like that TLT, baby. Oh, ghetto, we do back to back, just perfect excellence. Oh my God, that's God. That's it. That's why I put the point. You guys know that. Blended Dip said that on stream the other day. All I do is pray, and I tell God, guide me. He knows I'm gonna use my coin. And I get 50-50. I'm like 50-50. If I take it, I don't care. Maybe I'll keep it. I'm flipping that shit, bro. But hey, I see you, baby. I see you, Bar. About the real estate course, let's make moves. See, okay, maybe you can buy the real estate course. No, don't even buy the real estate course, honestly. Don't buy the stream alerts. Don't get impulsive. Okay? Seriously, you guys are honestly giving you advice here.
The department issuing a warning to all Americans, and this cruise ship, which has been stranded off the coast of California amid a coronavirus outbreak, is heading into port in Oakland. Let's get to Seema Modi for the latest. Seema.
Wilfred, U.S. State Department warning Americans with underlying health conditions to not travel by cruise ship as a number of coronavirus cases continue to rise. That's sending cruise stocks down as much as 20% just today. All three cruise lines are averaging a year-to-date loss of around 60%. Investors now taking a close look at the financial positioning of these cruise lines by examining their debt-to-equity ratios, which above 100% for Royal Caribbean, about 135% for a Norwegian cruise line. Today, Norwegian actually entered into a revolving credit facility with JP Morgan Chase of around $675 million to provide additional liquidity to that company. Analysts also warning Carnival's dividend of 8 to 9% may be hard to maintain at these levels if bookings drop sharply and costs around quarantines continue to rise. We are watching that Grand Princess ship approach the dock in Port Oakland with more than 3,500 passengers and crew on the ship from 54 countries. Guys, back to you.
And Seema, you've been talking us through some of the policies if you want to cancel your cruise. Just remind us, how long do you have to rebook it? Do you get a credit? I mean, what happens to that lost business?
So, Sarah, it really depends on the cruise line. For Carnival and Royal, you can cancel 48 hours before the date of your sailing, but they don't guarantee a full refund. In many cases, they offer you a credit which can then be applied to a new cruise or a future cruise. So that's really how it works. You really have to spend time calling the company if you are looking for a direct refund.
Seema Modi, thank you so much for that. Now, if you're just joining us, we're seeing a massive sell-off here on Wall Street. The Dow and S&P seeing their biggest losses since August 2011. The broader indices at the moment, the Dow is down 6.5%. That is off the lows. We're down 1,700 points. The low was down 2,100 points. Nonetheless, of course, an extraordinarily large decline. There is the Dow 30 stocks, as you can see. Right at the bottom, you've got Dow down 20% plus, and a number of companies down double digits, like Boeing, Caterpillar, and JP Morgan. One stock holding on to slight gains, and that is Walmart, up 0.9%. Still to come, TD Ameritrade Chief Strategist JJ Kinahan will join us at Post 9 to talk about what kind of trading volume the company is seeing, and in particular, what clients are wanting to sell and buy.
Number of key notes out from sell side this morning to tell you about. Bank of America saying stocks have not been this attractive compared to bonds since the 1950s on a dividend yield basis, and reiterated its bullish stance on tech and healthcare. However, not everyone is looking for bright spots in the stock market just yet. JP Morgan, for instance, saying a sustained buying opportunity not likely to come for some time. The firm suggests investors keep selling into any strength and reducing their positioning in stocks. UBS also predicting the sell-off is not finished yet. That firm pointing to key market dynamics, keeping them cautious, like elevated risk pricing in defensive assets like gold and the 10-year Treasury. And Moody's chief economist Mark Zandi joined us earlier on CNBC today and was asked about the odds of recession.
I'd say 60, 65%. I think it's going to be very difficult to avoid a downturn. How deep, how severe, it really depends on the administration and Congress. I mean, the Fed is going to cut rates to zero, and then the onus will quickly shift to the president and the Congress to come up with a fiscal stimulus package.
Lindsay, where are you guys on your call for the market and whether it's linked to a coming recession?
Yeah, I mean, the news out of the energy complex really does add an element to the situation that we're in right now that increases the risk, okay? Energy is 8% of the economy. It's a smaller portion of the S&P 500 index.
More like three.
More like three, yeah.
Hit so hard.
Yeah, so it's much less of the index, but it still is a big part of the economy, and you have to think about all the industrial companies also that feed into that industry. So look, I looked back at 2015, 2016. We came from a position of strength going into that. That was an energy-led economic slowdown. There was a slowdown in investment spend and CapEx as well. And we came from GDP rates of 3%, and it was cut basically in half in the third and fourth quarter of 2015. So that could potentially be something like what we see from a GDP perspective this year. We're coming from a little bit weaker stance. But then on top of that, you have to throw the coronavirus impact and what that does to economic growth in the travel, leisure, and entertainment areas, too, which are much smaller. But so I'm more worried about the energy complex.
Mike, do you feel like the market is priced in a recession now, or are we not quite there yet?
I would say not fully, no. I mean, you've kind of started at a very high valuation level, relatively speaking. I do think there are parts of the market, however, that have gone a far distance toward pricing in a pretty bad run for earnings in the economy. If you look at the cyclical areas, there's something like 150 S&P 500 stocks that are down at least 30% from their high. I mean, it's not as if everything was going up until 3 weeks ago and they've all come down 18% like the S&P has. So I think we're getting there. I don't think we've generated absolute value, but to the B of A point about dividend yields, you have to figure out how to interpret this new world of ultra low Treasury yields, because for the entire history of markets until the late 1950s, dividend yields were always higher than Treasury yields and than risk-free bond yields. Then they went down for 60 years. They went below, and I think we're probably flipping the switch again unless Treasury yields come up quickly.
So you don't buy the fact that
I don't think that in itself,
because dividends pay higher yields than Treasury.
I don't think that in itself, certainly not tactically. Maybe longer term, they're going to be privileged if you have steady dividends, because there's just only so much yield in the world. They will get supported on a valuation basis, but I don't think that that's your buy trigger simply because we've crossed that threshold.
But also, Mike, how many limits are there out there that bond investors aren't going to be able to take their profits and shift it into dividend-yielding stocks per se? It's not as simple a switch as, oh, this stock's up, this stock's down. I'm readjusting my portfolio.
Right. I don't think it's necessarily a flow from one into the other. It's just the incremental marginal dollar. Does it go more likely to dividends, dividend-paying stocks versus risk-free bonds? that's the question.
We have got just under 30 minutes, 27 minutes left of the session. Here's a look at the major averages. We are down 7% on the Dow, just shy of that on the S&P, down 6.3% on the NASDAQ, and 8.7% on the Russell. These are single-day moves. Extraordinary. Bob Pisani's here on the floor of the stock exchange looking at all the biggest movers. But Frank Holland, first of all, having a look at the biggest sellers on the NASDAQ. Frank.
Hey there, Wolf. The NASDAQ trading below 6% lower, and on pace for its worst decline since August of 2011 when the U.S. debt downgrade happened. Only two stocks in the NASDAQ 100 trading in the green. That's O'Reilly Auto Parts and Dollar Tree, both with strong U.S. retail domestic networks. On the other side of things, tech and transports, both of those trading lower. Tesla trading 12% lower, definitely facing a headwind from lower U.S. gas prices for that automaker. Chip stocks falling dramatically as well. Western Digital falling by 11%. Micron down by 9%. FANG stocks also trading lower as we get into the close. Apple having the biggest negative impact on the NASDAQ 100 after reports that it sold dramatically fewer iPhones in China as this coronavirus outbreak continues. Now over to Bob Pisani at the New York Stock Exchange.
And Frank, we had JP Morgan, one of its worst days since the financial crisis. But this is a day for circuit breakers, a wild first hour. Been quiet really since the first hour. But I want to show you Halliburton as an example of what circuit breakers can do. Look at this stock. We had a halt at 933. That was the first one. That was the S&P 500 halted, as well as Halliburton. But then Halliburton was halted again on an individual circuit breaker just for Halliburton, 10 o'clock Eastern time for 5 minutes. And then a third time at 10:22, another individual circuit breaker halt for another 5 minutes. So 3 trading halts in 1 hour. Haven't seen that. I don't remember when. And you can see Halliburton down about 37%. I've been asked a lot about gold stocks today. What's going on with gold stocks being down so notably? But wait a minute. Gold's up. And this is because gold stocks act like stocks sometimes. And we have concerns about slower global demand for gold potentially out there if the global economy slows down. And of course, you've got some people out there saying the gold miners could suffer because of that. Guys, back to you.
All right, Bob, thank you. Just want to give you a check of the S&P sector heat map. Every sector is lower in this broad and sharp sell-off here on Wall Street. Energy is by far the worst hit, down 18% at the bottom of the pack after crude oil is almost 25% plunge. Financials, second worst performers, very much tied to the energy story and the low yield story. That group down 10.6%. The ones doing the best, consumer staples, healthcare and communication services, they're all down at least 4%, which gives you a sense of the size and the scale of the selling that is going on. I think there are 10 stocks in the S&P 500 that are actually positive as it stands.
Ready for some tin foil, everybody?
You want me to? Can I do it? Because there's so many things that it's just killing old people. Like, are you ready for the scary part? It's just going to kill old people. It could depopulate China. It'll benefit them. If Japan loses their old people, it will spur their economy, benefits them. And then look at our government. Who are the people in government? It's just a bunch of old people. Ted Cruz already went home. There was somebody, that CPAC guy in the White House already got it. Like, think about that. This is shit's wild, bro. Social Security, yeah, bro, this is some crazy shit. So that's my tinfoil theory. So there you go. Just kind of wild to think about, but you guys are good. I mean, but it's everywhere now. I'm pretty sure at this point. So, kind of crazy. Promised a pension plan, received the virus. I'm old. Well, be careful. Honestly, if you're older and you have other pre-existing health conditions, I would take this seriously, and I would be careful. I mean, if you're younger, I mean, you're either going to get sick and be out for 2 weeks, and then you'll be back up. But that's pretty much it. Man. 20 minutes to go, baby. 22 minutes.
20 minutes.
Bob is smacking us. Yeah. I mean, we got enough profits though. And that's why I said be careful. If you guys are opening plays that Bob is down 30%. Shit. If you're opening plays I'm like right now I'm playing with house money. So I'm gonna push it to. I have a limit on house money I'll push, and then after that I'm gonna just go back to normal. So pretty much I think about it. I made 100K. I made like 150K so far in the last week and a half. I'm gonna put out like 10 grand percent on trying to parlay. But other than that, I'm not gonna walk away with less than 90 at this. No way. Even like 140. Fuck that. Yeah, because my normal I go back to I put $500 in TLT, bro. Come on, Dad. Yeah, selling spreads will be your best. Condors are a little bit different. Am I worried about, bro? I answered that question like 30 times. I said, no, I'm chilling on it. Relax. It's okay. Calm down. God is good. I think that play's still up, right? The key is you want to take profits on everything else or ghetto spread it so you could be in a position to not even trip on them. Where's that Wally World at? Yeah, we're still up on those. The Wally Worlds are up 68% still. Yeah, I'm still holding that. Should I go to school for finance? Nah. I have a degree in political science and a degree in philosophy. So I'm technically a scientist and a philosopher. Isn't that wild? That's crazy. Oh, and I could be Elmo too. We got ponies again.
Holy moly.
Oh, you're having a wonderful day. Okay, bye.
Alright, so they're pushing the market up here. That's for sure what they're doing.
No, Russia has it. That's why we got to see all the responses, bro. All the responses are going to go. That's where we still have to wait for. But again, watch as we make the move towards VWAP. But take a notice now. This is different than the first bounce up. You see how VWAP was going up? VWAP is coming down now. People are overreacting. Well, it's kind of what I just said. I mean, not everybody needs to overreact, but certain people should react. Josh, do you like or have plans for Twitter or Starbucks? Love you. I love you too. Why are you yelling at me in every message? Ah!
Wow, yeah, you are loud.
I still hold in the Starbucks. I ghetto spreaded that. Twitter, I don't like to touch Twitter. No. I didn't exit all of them. So we exited fully out of the Aprils. I ghetto spreaded the Mays, and then I'm keeping one. So remember, I did tiers. I did 3 different tiers, and then I'm holding the tiers. So think about how the timing went off, and then what's going to be more protected, the ones with time. So I sold off everything, and then I still have this play right here. Hold on. I still have the TLT Junes. These ones are crazy. So I sold out all of the Aprils, ghetto spreaded the Mays, and now these ones are just totally naked right here. The TLT. $1,000 initial investment. Very good in my country. Yes, I keep the further one because it could go down 50% from now. I still be up 1,000%. I still be up about $15,000. Now, the bond is going to make a bounce. If you're familiar with how the bond market will move, what is going to happen? It's going to make a big drop, as we've seen many times. But what will happen, given this current rate environment and how market is pricing in many things, it is going to find a baseline that will not be too low, given the divergence with S&P 500. Okay? So pay close attention. The June ones will be good, but the April will be a little susceptible to danger. However, now, the Mays are very good, but I did want to take profit on May to make sure I walk away with 50% gain on that other account. So now I guarantee the profit there, and by taking this profit, it will help me hold the IWM, EEM, and many other plays to still play off my country fucking up oil. Okay?
Okay,
There you go.
sounds good.
Very simple. But I hold June now. Everything else, you say impeccable time. That's I looked at the clock to do this. That is it. So now we hold the last tier of TLT. You wait till the market does whatever the hell it wants to do. Then market make a bounce. The play will get a loss of premium, and then I make a double dip, and then we attack it. We attack it very hard. We'll cut it at the knees. We play dirty, okay? I cut it at the knees, I slash Achilles tendon, and then I find the best way to take the more money of extraction. Okay? Very simple. Telling you, they teach this secondary school. If you go, or you pay attention to watch list. Second link, nightly watch list. You're not familiar with my plan for this, it will be very, very helpful to you. Okay? If you're unfamiliar, watch list will make sure you are caught up to familiarization. So I see you on watch list tonight. It's going to be exciting. I can't believe they halted the market. I thought it was Russia for a second. It's crazy. Welcome. You've made a killing last couple of weeks. Consider donating to a local charity. Share the positivity, keep karma level high, chads. I like this, but you make this decision in 3 weeks. Okay? Don't charity, don't pay off anything. You need to keep the money. Again, impulsive. I don't like impulsive charity giving. Okay? Yes, it could help with tax benefits, but still. Make sure you relax. I want you to think about your next decision. It could change your life forever. That's what they say in my country.
Yes, it can change your life forever. I agree. Oops. Sorry, everybody.
We gained a day. We went up another like 55, 60 grand, and then I took 30,000 in profit. Realized today. That's where we're at. And now we got 14 minutes remaining. You think there'll be a big play? Yes. I rebuke the FOMO, man. Just wait. I'm telling y'all, just wait. Even if you made the money today, isn't that crazy? What was my advice for the people who made money? Y'all don't feel me, man. My advice for the people who made money, I said, wait. Even if you made money, I said, wait. Oh my goodness. Oh my goodness. Isn't that crazy? It's universal. It's a good strategy. Just wait. Y'all can't wait. Y'all don't wanna sit down with me every day. Huh? You don't wanna wait with me? You don't wanna wait? We can't just sit here and wait. You don't like me? And my voice getting annoying? You can't wait?
Yes, it is. I'm going to turn on CNBC to shut you up.
Come on. Thank you.
So we've got 14 minutes left of the session. We're down 6.5% on the S&P 500. Time for the last chance trade. Lindsay, what are you going for?
Well, I think when you look at the market for opportunities, what you really need to take into consideration is the environment that you're operating in. And right now, that's an extremely volatile environment. It's one that there's a lack of direction and clarity with regards to economic data and earnings forecasts. And for that reason, I started looking at GLD. I know Mike talked about how there are some different indicators where maybe it's starting to become a little more overvalued. But when I think about gold, this yellow metal, it really benefits from central bank activity. And that's when monetary policy is easy and going to continue
Wow,
to
geez,
ease.
Lindsay,
Also,
sorry,
when there's an
you need
expectation
some
for
more
fiscal stimulus
education.
to increase, gold usually does well.
You
And
were
when
a
we
gold
have
bug,
this
probably
amount
just
of
following your
uncertainty, you've heard
husband.
many guests come on your air all day today talk about they don't know where the economic environment is. Gold has historically been a very good store of value, and it usually outperforms
Down
in a down
1,700
market.
points
So for
here.
that reason, I took a look at
To
GLD.
say to see that
Wow,
it's flat on a day the market is
1,700
down
points.
1,700 points.
Well, you know what? The same thing happened last week. It declined, or 2 weeks ago, it declined 5% and then popped 7%. So I think that you just see some investors really taking profits here if it's to make margin calls or just really take money off the table and put it somewhere else that has come down significantly.
Going into yen, Swiss franc, some other favorite safe havens. Coming up, we're going to have much more on the sell-off and how investors can protect their portfolio
Guys,
when we are
I
joined
might
by Mad
want
Money's
to
Jim
pick up
Cramer.
something
Looking
here.
forward to that.
We've got 12 minutes left of the trading session. We're now in the closing bell market zone. Commercial-free coverage of all of the action going into the close.
Today we've got Ally Invest Lindsay Bell, CNBC Senior Markets Commentator Mike Santoli, and Cantor Fitzgerald's Global Chief Market Strategist Peter Cecchini here to break it all down. Let's kick things off with the broader market. The Dow is now down almost 1,700 points, on pace for its worst day since December 2008 and looking to close at its lowest level since January 2019. The S&P 500 plunging more than 7% at the open. That caused a circuit breaker to actually halt trading for 15 minutes, reopened, and now we're seeing the S&P fall sharply as well to the tune of 6.3%, looking at its worst day since 2011, though I think May 2010 is also in play here. That was the day we saw the flash crash. I mean, it is broad and it is large, Mike. A lot has to do with oil, and I guess a lot has to do with the coronavirus. How would you put it into context?
I would say it's a kind of complex correction in that sense, in that you basically have all these different elements that are pushing the market around. I think today you get to further extremes, right? A week ago you were able to say, wow, this market's getting a little bit oversold in the short term. 18% in 3 weeks. It's a pretty big bite. I think it probably takes incremental bad news on a very immediate tactical basis to get it too much lower, unless we have something blow loose in hedge fund land or in credit markets. But that being said, I don't think you've created true absolute value cushion under this market, because we started from an expensive spot. So I think you can kind of play that both sides and say, wow, we really ought to be rallying here. That time in 2011, Sarah, you mentioned we were down 6.66% on a Monday, and you did rally big the next day, but it wasn't over for the correction.
Peter, you were cautious before all of this.
Wow, guys. 10 minutes here.
Starting to turn.
That out of the money IWM play, that's $75 in the 3 gram right now. Yo, SPY's coming down big. Hold on, that's a big candle.
Whoa, that's a big candle. That is a big candle.
It's probably the yen. The yen bounced back up there. That's weird. That was a big move. Yeah, I got 9 minutes. There's probably going to be an Ocean's 11. What's the volume at? 260. Yeah, we're going to do, there'll be 40 million in after hours volume. Bro, we're still not even hitting the top though at 385. Ugh. Shit. Tomorrow could be a little bit bigger here unless it reaches a different level. Yeah, I can show you guys an after hours play. Make some moves. MOC 304. Another Black Tuesday too. Bro, I can't believe you guys realize we had a halt today.
Yeah, I can't believe we had a halt today.
Y'all let that sink in for a second. I don't think you guys feel me on that, man. Like, do you really realize that? Like, how crazy that is?
Dang.
Like, that was crazy. Like, this is just like when they did the emergency cut. You guys remember that? You guys remember that? Remember I was tripping? Like, it feels so surreal because it's still the same day. That's crazy. Market on close 1.8. That move right there was the other 1.5. First emerging. Well, that's the thing. It's not first an emergency cut and then a halt. Pay attention to how important that emergency cut is. That halt could have been caused by that. However, this is why it's all connected, because even again, when they cut, they see something. They would not have made that cut if there was a problem, and that's what's happening. Oil's dropping even more, man.
Bye bye oil.
I wish we were gonna be able to get we can't play any. Tomorrow we might be able to play them. Stream alerts, you'll have to. If you just signed up, you'll have to wait on it. I mean, it should be almost instant, but give me some time. But you should be getting it. If it takes longer than 24 hours, shoot an email. You're holding the SPY ones. I think I sold them a while ago. I mean, you have a lot of them. Those should be paying out 3,000–4,000%, right? Yeah, those are 3,000%.
Dang, that time value just erodes so quickly.
But it sucks because I have the IWMs, and oh my god, bro, that IWM play is $2 from the money. Yeah, see, that's why I'm gonna keep holding that, bro. If that IWM hits, that'll be $75 into 15 grand. On that, that's one of those crazy spreads.
Final 6 minutes.
This is the IWM play.
Ooh, look at those sell bars. Those are big sell bars. Those are huge sell bars.
You guys remember this? It expires next week. That's why it's risky. But that's $75 for like 125 into 3,000 though. You see, if we close it, 2,900 profit. That's crazy. Is MOC still 3.5? My shit's lagging heavy right now. Yeah, I did a daily YOLO play for the Ocean's 11. I wanted to set it up now. I only got one.
4 minutes, guys. What are we going to close at here?
I only got one of it. So again, if you guys don't know, I type it out for the stream alerts. Once the stream alert goes through, I make sure. So I do. If I do it on stream, I just make sure it comes out all at the same time. So that's why. Yeah, give me a sec here. I have to type it out. All right, I did it. It's already doubled. Yeah, see, it's doubled even before the stream alert. That's because it's a YOLO daily. It expires today. SPY. I got a 275 put at 25 cents or 28 cents. Woo! Well, if I go in the money on that, hit me with the YOLO, baby. Hit me with the YOLO, baby. It's a daily expiration. Do not trade it. Do not trade anything you see on this stream. After trading shilling, the candles almost around.
Yep, don't trade anything that I trade here. We only got 2 minutes left. I always lose my money. Look at this over here.
15 minutes after market.
Just lose money.
11, but do you see what I did? I'm timing it before because I see it coming down. So these were just $2 out the money. I just grabbed that at 28 cents. So don't buy this. Again, be very, very careful with this.
What did you just buy? I didn't even see it.
Yeah, tomorrow's going to be ugly. See what I said? If it comes back and ends below here, or even after hours, it's going to be a mess.
Oh,
yeah, that
man.
player already went up 300%. 2 minutes. The SPY put expires in 15 minutes. I only put $25. Come on, you can't. It's a YOLO. It's a good $25 play given the situation. But that's not one you would have. You would have made 300% on it, but still. baby. So why to Ocean? This will trade after hours. So even though it expires right now, the thing is, this could, I mean, we could hold this for 15 minutes. So if it starts selling off after hours, which is looking like it might, we can still profit 1 minute. Oh, ladies and gentlemen, sorry about that. We're a little bit late here, but we're approaching our landing here. It's getting a little bit bumpy, so please hold on. If you guys have any bags expiring, please get rid of those now. Otherwise, if you're going to be keeping those bags, please stow them in the overhead bin above or firmly underneath your seat. Do not move until we fully taxi into the gate until the bell rings. We're going to be remaining about 15 minutes a little bit later here for these Ocean's 11. Otherwise, we'll give you an update on your layover. Second link in the description, nightly watch list. We'll let you know when the next flight is and how we're going to set up the itinerary. Other than that, we appreciate you guys' business. Thank you for being here. If you guys are interested in your Colt Rapid Rewards card, please reach out to your flight attendant and they will give you a brochure. Other than that, thank you. Have a wonderful day and we appreciate your business with the Colt. 1 minute! Actually, 10 seconds. Oh, let's go in the money on that. That plays $20. Let's go, baby. Look at that. See, that's a... Oh. Let's go, baby. We did it. We made it. We did it. We made it. Oh, let's go. Let's go. I love you guys. All right, I need to watch this play, though. I want to see how we got to finish this out here. I'm in it. I just bought that for $25. It is now trading at $150. Holy shit. Look at that. Oh, 273? Oh, you're kidding me. Oh my gosh, that play is ridiculous. Yo, that play is ridiculous right now. Are you kidding me, man? Bro, that's 1,000% in 5 minutes. Oh my gosh, what a YOLO. I told you Ocean's 11 here. Oh my goodness. Oh my goodness, baby, at the buzzer. Oh my goodness, hold on. So we got 50. Let's see, are they gonna? I don't know, bro. Oh my goodness. Oh my gosh, yeah. So make sure you like the video. This will determine our YOLO amount for tomorrow. But holy.
Here's the at least past
$200 and 200 right now.
We are down more than where the circuit breakers kicked in this morning. The S&P closing down 7.7% in points term on the Dow, over 2,000 points. Sarah, back to you.
That is the worst point drop for the Dow ever. Welcome to Closing Bell, everyone. I'm Sarah Eisen, Wilford Frost, rejoining me in just a moment along with Mike Santoli, CNBC's senior markets commentator. Take a look at this ugly, ugly day on Wall Street. The Dow closing down 7.8%. Worst day for the Dow since December 2008. And as I mentioned, worst point decline ever. The S&P 500 losing 7.6%. Worst day for that index since December 1st, 2008 as well. The tech-heavy NASDAQ also getting crushed. This was a broad selling day, down 7.3%. Worst day, it looks like, for the NASDAQ since 2011. The Russell 2000 index of small caps also getting smoked. A lot of banks make up that index as well. Banks were among the hardest hit in the market. Russell 2000 down 9.44%. On the close. Energy got hit the hardest after crude oil declined almost 25% as Saudi launches a price war in the middle of what is perceived to be a big shock in demand from the coronavirus fears. Oil, by far the worst performing group in the market. Coming up, Mad Money's Jim Cramer joins us with his thoughts on this massive market sell-off. He'll tell us what he thinks you should be doing right now with your money. Joining us to talk about the market today, Eric Knudsen. He is multi-asset CIO at Neuberger Berman, which manages $365 billion in assets. Still with us is Peter Cecchini, Cantor Fitzgerald Global Market Chief Strategist, Lindsay Bell, Chief Investment Strategist at Ally Invest. Though first, Mike, to you on what we just witnessed today. It's brutal.
Obviously brutal. I mean, the market's rushed toward a place to say we have to start handicapping the probabilities of a recession in this country. Certainly we haven't priced that in right yet. The verdict is not yet in. I think you could probably look at the washout conditions in the market and start to make a case that there's been enough selling for now if it was just an equity story. I do think everyone has one eye, though, on what credit spreads are doing and just
wow, guys,
the
that was
readings out there,
2,000 points there.
A certain contingent of market players are kind of trapped in forced hedging, and there's a lot of unease and bad vibrations in the market. That's the way it is before you get some kind of a big reversal rally, but it's also the way it is before the market
Down
deepens
big.
into a deeper correction.
Peter, on that note, what are you looking out for, the key triggers that would make you turn to be a bit more constructive, a bit more bullish again?
Well, I'm looking at the rates markets, and the rates markets have been singing a bearish tune for quite some time. The 10-year dipped to about 35 basis points.
Although it rallied up to 50 basis
it
points.
did. It did. Big moves all day long. The 3-month to 10-year spread, not to get too esoteric, intraday moved 30 basis points. It was down 20 and then it was up 10. It's really a really interesting time in the rates market. So what I would like to see is a bit of a steepening in the yield curve, which likely cannot happen because Fed funds right now is still well above the 10-year. So I'm actually expecting the Fed to move at its next meeting with another series of cuts, and then perhaps I will get more constructive. But the problem is the fundamentals have been weak for a while, and the coronavirus is just, as I've been saying, an extremely heavy straw on a very weak camel's back.
So junk spreads have jumped the last 2 days, but they're still below where they were in 2015 to 2016. So do you think we get to that level or above before the pain is over?
Well, I'll tell you, it's interesting. You know, I grew up in a world where credit markets led equities every time. A couple cycles that I have lived through, that was the case. Now I think it's different, and I think the equity cushion under credit spreads has allowed for a relative value mindset that has persisted for a long time. In other words, if you're taking...
I have 6.5 in the YOLO bank now for you. So I like that. I appreciate you guys, though, for real.
Yeah, I appreciate everyone that's giving me a thumbs up also. Thank you, everybody. You guys rock. You guys are great. I appreciate everything.
Have another kid, and you know, it's like now you guys are seeing all the new chats. You're already grown up. You're like, why did they get the attention? I hate this. I get it, but thank you for being.
Partly for ease of liquidity and implementation. A quality orientation, and that's something we want at this point. It's not yet time to go looking for kind of deep value or bombed out areas of the markets.
Okay, let's get a summary, by the way, on this crazy day that we just had. Bob Pisani's on the floor of the exchange with a breakdown of a crazy day, as I said. Bob.
Yeah, and so the good news is the circuit breakers kicked in very early, added liquidity, calmed the markets a little. The bad news, of course, we did end to the lows for the day. Energy down 18, banks down 14. Industrials down 8%. I just want to show you ExxonMobil down roughly 11% on the day. This would be the lowest close for Exxon since 2004, believe it or not. JP Morgan Chase down 13%. Or so. That was the worst decline since March of 2000. You got to go back to the financial crisis to see a decline of that and this kind of percentage on a daily basis. Industrials generally fared poorly. Caterpillar and 3M as well. 3M down 5%. They're 6%. I'm sorry. You see that? That's a 4-year low for 3M. And Dow Inc., which you can associate with the truly global industrial materials economy, global coatings. Think that is not a typo there, down 21%. Remember, it just came back to the public markets a little, about a year ago. That is, of course, a new low for that stock. Guys, back to you.
All right, Bob, thanks. Another historic day as well for the bond market. Let's go to Rick Santelli at the CME in Chicago. Rick.
Hi, Sarah. You know, markets right now are trading some very important levels. Look at a 24-hour of 10s and realize that Friday's low yield in 10s was 65.65. Right now, today's high was 60, and that was after a 31 print. And the point is we're trading 59 now. If we leave gaps, and we left a gap, and we go down below the lows, which are 31 before we fill that gap, that is much more bearish for lower rates. So filling this gap and what we do once we do is significant. Finally, if you look at the long-term chart of 10s, a lot of it's technical. The minute you took out those double bottoms in 12 and 16, it accelerated. Dollar index, as soon as you took out, see the year to date, where it closed last year, it accelerated. This is important. Uncertainty is always addressed by technical features, so you need to stay on top of them. Sarah, back to you.
All right, Rick, thank you. Energy stocks got absolutely crushed today. Our next guest downgraded almost every exploration and production company he covers on what he says is a potential energy Armageddon. Joining us now is Neil Dingman, Managing Director of Energy Research at SunTrust Robinson Humphrey. Explain what you mean, energy Armageddon. I mean, we got a taste of it today, but how much more is likely to come?
Yeah, thanks, Sarah. You know, again, you hit it earlier, and that is it's unprecedented to see this kind of pressure, both not only on the supply side, but the demand side. Again, here, we don't know what the fully demand destruction is going to be, nor do we know how much the supply war is going to cause supply to continue to ratchet up. So standing back, taking a look at that, we thought, you know, prices certainly could get down in the 20s. We have seen that, and we think they could stay there for a little while.
Peter, just want to come back to what the stocks have done today. Do you think the oil stocks are suggesting large swathes of this industry are going to go bust, or is it just a move based on, earnings estimates have to come down?
Well, I think, again, you've got to bifurcate, so similar to your technology names. The big companies that have good balance sheets will likely survive, and that'll be an advantage to them. But the smaller guys that have access, that need access to capital markets that are cash flow negative will suffer, and the privates will likely go under very, very swiftly.
Talk about within your coverage, Neil, who's going to suffer most, and what does that suffering actually mean with the price of oil at $31 a barrel?
And there's definitely a number of names that have both maturities and, there's the RBL redetermination coming up. So when you look, some large companies, Oxy obviously has a lot of debt after the Anadarko merger. Chesapeake, of course, has a lot of debt outstanding, as does even, better credits such as an Apache. All those have relatively high levers with some maturities coming that they're going to have to address, just for some large companies there.
What's the key, Neil, what's the key oil price and the length it has to remain below before those companies start to feel the pressure seriously? Is it 1 month where we already are, or do we need to see another leg down and it lasts for the rest of the year?
Most of these companies, again, they've got to be closer to $40. So, again, we're obviously quite a ways from that. So, to me, if we're down, let's call it 2 quarters, well into the back half of this year, and we're still under $40, it definitely will be troublesome. I'd put it this way, Wilfred, I don't think any of my companies make free cash flow at $40. They're going to have to figure out other things. In fact, direct quotes from my CEOs today said, it's all about survival for us. It's not about valuation. And I think that's very much what most of them are looking at.
The president tweeted out, Mike, today on the oil prices that, gasoline prices go down for Americans. That's good. It puts money in their pocket. If you look at what stocks actually went up in the S&P, I think there were under 10 of them. One was Dollar Tree. I thought the other dollar store
Walmart was up for part of the day as well.
Clorox. I mean, there are, there is a silver lining for the consumer. Sure. I'm not sure, though, if you have coronavirus fears, you're going to go out and spend that money.
Right. I mean, the buying of necessities trade will work in this environment. I still don't think that from a stock market perspective, the small windfall in terms of price per gallon is that significant because the oil intensity, that's just not as big a portion of the consumer expenditure set as it used to be. It doesn't hurt. It's an offset, but I don't think it really changes what's going to be a real retrenchment cycle in the energy industry.
The amount of jobs lost and that the energy patch is going to have to go through, I think is going to have a much bigger impact than the couple dollars that families are going to have to spend from the savings in oil.
Peter, is there a sector you'd buy today?
Again, my favorite amongst the
REITs.
carnage is the REITs, and I've been singing that song. I'm sticking to it.
So hard to get excited about.
Yeah.
Eric, final question to you. Is there a U.S. S&P 500 sector you'd buy today?
Again, quality and yield. We think that once the dust settles here, where you look at where treasuries are, there's going to be such a demand for yield. So we're looking at quality and we're looking at yield. So REITs can certainly work. We're also looking on the bond side. We think there are going to be some really interesting opportunities to be a liquidity provider and investment grade credit. And there's going to be a lot of demand for those bonds. And right now you can pick some up at a pretty good bargain.
Okay, we'll leave it there, everyone. Thank you so much, Neil, Eric, Peter, and Lindsay.
Thank you.
For more on this historic sell-off, let's bring in Mad Money's Jim Cramer. Jim, as always, great to have you with us, particularly on a day like today. I just want to read out some of these statistics for you. This is the worst point drop for the Dow ever, the worst percentage drop for the S&P 500 since October 2008. Jim, do you feel that you're getting reminded of the 08-09 financial crisis on days like today?
No, I think I see much more of a reminder of the J-Powell bear market. And unfortunately, we're still not to where we were in the bottom, the Christmas week of 2018. We fell down there, S&P 2339, Dow 21770. I think those are good levels because I think that people think, listen, it's going to be a recession. And if it's going to be a recession, then we still have a little bit more to go. I did see some things to buy for my travel trust the other day. First time we've bought anything. Because there's just such declines in the pharmaceuticals, which I think should hold up. I just saw Sarah mention that the Dollar Generals and the AutoZones go up, and that's okay. Yeah. I get that there's a recession, but I want yield, and there's finally some yield, and it's great to see.
Where are you looking for that yield? Which sector in particular?
Well, I've got to tell you, I look at AbbVie, and I can't believe I'm getting that gift. How about Bristol Myers back over 3%? Bristol just made that acquisition with Celgene. They've got some huge cost savings coming, and it'll be accelerated buyback they're doing. There's just so much to like about it, Bristol. Because I say like about it because you can buy it here, and if it goes down, which it could because it's part of the S&P, then you can buy more of it, and that's what I'm really looking for. I'm looking for situations where it could go down and you don't say, oh, I got it wrong. You can say it went down. I say, oh, good, I like that. So I think that's good. I don't even mind Amazon here. I think that you can buy some Amazon and then buy some more just on a scale because, holy cow, if you're really staying at home, that's the only way to shop.
Jim, I'm looking at my dashboard here. JP Morgan Chase, 3.85% dividend yield. What do you make of that?
I'll tell you which one you want to go. I'll see you one and raise you one. How about Charlie Scharf at 6% without the problem of Elizabeth Duke being the chair? I mean, don't you think that's interesting? I mean, there you got a guy with a full new slate of people with Maxine Waters all over him. He didn't even do anything. So I kind of even like that. 6% with Charlie Scharf. I'll bank with Charlie.
On that point, though, Jim, one big question that always comes out when people say, oh, it looks like it's a good dividend yield, but might that be a sign the dividend is going to be cut? With the banks, do you take strength on the fact that they've got a lot of buybacks they could cut first, that those yields, 3 to 6%, whichever one we're looking at, are very safe?
Exactly. Look, if Mike Corbett doesn't want to continue to buy 8% of the company back because it's below book, and that's tangible book, he can stop doing that if he wants to. I look at something like J.P. Morgan. Obviously, yes, we want Jamie to wish best of health, but it really is amazing. I think if that actually Jamie were back at his desk, you would feel, well, wait a second, I'm getting a chance. I know people hate the banks. I heard all day that the oil companies can bring down the banks. That is actually not true. I didn't like the fact that J.P. Morgan apparently did a revolver with one of the cruise ship companies because I think the cruise ships have become wasting assets. But when we look at the oil companies, they're not all knuckleheads. They're not all Occidental.
Just on the broader market, Jim, there are so many uncertainties right now on coronavirus. How many actual cases are there in the U.S.? Right. What does the mortality rate actually look like? I mean, what do you think it's going to take for the market to be able to see out onto the other side? What is the headline or the news?
We want fiscal, we want some sort of
tests.
fiscal commitment. We want public health to have all the money at once. We want a Manhattan Project to try to solve this. And we want the test kits. I mean, you take a look at Japan. They have not had their numbers are peaking. And the main bulk of the numbers are from a cruise ship. I would love to see our numbers peak. I don't want to be Italy. I want to see what happens in South Korea. And I'd like to be able to test. With the test kits, I know my confidence would come back. I understand that the president wants to tweet that all is well. I think you have to hope for the best and prepare for the worst. You don't just hope for the best. That is a sucker's game.
Jim, you mentioned they're not all knuckleheads in the oil industry, and we've seen some massive moves today, even with the strong balance sheet oil companies like a BP or an Exxon. But putting those aside, when you focus on some of those smaller, over-leveraged oil companies, is there a chance that one or two of those go bust? And if that is the case...
Why are you saying one or two? I think that of the 37 that I followed, courtesy of Rusty Brazil, I think fully maybe 9 or 10 can go. I'm just saying that I'm not going to sell Wells Fargo because of them. I would sell the oils. I don't care for any oil. Now, I didn't care for any oil beforehand. I know the industry felt that I was a pariah, an apostate. I just don't like them. And now I really think that people are joining me because if it's lower longer, there's no place to hide.
But Jim, if you've still got a handful of those companies then that could go bust until we get those headlines, will the broader markets not follow in line with that?
I think that would be a mistake because these companies are no longer a big part of the S&P. The Occidental shoe has to fall. The Occidental shoes have to fall. There you saw the bonds trade down 25 points today. The big 49 bond, the 4 and change 49 bond. You can't. I think that when that goes and you see it as the lead story in the paper and Warren Buffett lost a lot of money on it, if that does happen, I think that could cause another leg down in that group. But what I'm looking at is you remember the banks were stress tested 25, 26 for the oils. I feel better about the banks than I do any oil company.
Jim, just overall, I mean, is it panic? What do you say to the extreme
I wish
sentiment
it were,
shift?
Sarah. You know, they did the halts, and suddenly everybody's calm and they're picking. You know, the picking thing doesn't work. We got to wait for this is a different market because we didn't count on the oil problem. Before the oil problem, we thought maybe we're okay. And look, I want to believe the president. I want to believe that if we tested everybody, everything's pretty good. That would be terrific. But the fact is people are working at home. Deals aren't closing. Restaurants are hurting. There's no backstop of no interest loans for the people who, frankly, deserve it because they're hardworking people. When I speak to Dave Tepper, I know that earlier Steve Leisman talked to Dave Tepper, and I know he made it sound like that Tepper's like, hey, sanguine about some things, an orderly bond market. But we both feel that without fiscal stimulus and some kind of more aggressive leadership from Washington, we're going to run into another down day like this until we get to where Jay Powell put us in December of 2018.
I do think it was notable that, there were reports, and Eamon Javers reporting earlier that the Trump administration, the economic team, is starting to weigh measures to deal with this, paying for sick leave and business, but it didn't really do much to give the market a confidence boost.
Well, they didn't really come out. I mean, plus you have Secretary Mnuchin. I think he needs to come out because the president's got himself in a bit of a box. I mean, if everything's so darn good, like he says, then how do you therefore then offer these different programs for the small and medium-sized businesses, which we know will be crushed? And any of us who have small and medium-sized businesses, we're looking and saying, okay, if we have 4 or 5 bad weeks, can we carry people? Yeah, these are totally legitimate businesses all over the country. Can we carry them? And so I think that that's a big problem. And I think that the credit issues that drive J.P. Morgan down 14, American Express down a lot, these travel and leisure and credit card are frightening people. And I wish that they didn't, but they are frightening people. So I expect another day that's not so hot, if not multiple days, if the COVID really heats up again, which I think we all think will. Do you guys think so?
Jim Craig?
Are you worried?
I think it's hard to predict on an individual day, but...
Do you wash your hands all day and wear Perel?
I wash my hands all day, but I'm not too worried outside of that.
You're not?
No, but I take cautions. Like everyone should take cautions, and I'm not going to unnecessarily get on a plane, and I'm definitely going to wash my hands a lot. Jim?
Well, Jim, we're going to listen to Dr. Fauci, right?
Look, I love Dr. Fauci. That last line, man, Royal Caribbean. I mean, can you imagine if you're like watching that show? He said, don't take a cruise ship. It's like, whoa, okay, let me do some cancellation of that.
Jim Cramer, as always, a pleasure. Thank you so much for joining us here on Closing Bell. Don't forget to catch more of Jim tonight, 6 p.m. on Mad Money. Joining us now to discuss things further, Neil Ferguson, who's out with an op-ed in the Wall Street Journal today. It said, quote, network effects multiply a viral threat. Detailed how coronavirus is spreading faster than most Americans realize. He joins us now. He's, of course, senior fellow at the Hoover Institute. Neil, good to see you. Thanks so much for joining us. I guess the first question is your take on where we are on the scale of acceptance of how serious this virus is, and whether there's a lot more realization of bad news of the reality to come.
Well, the answer, Wilfred, is that we don't know where we are because the United States is lagging behind on testing to see how many people actually have got the COVID-19 disease. Now, the indications are that the United States should be as exposed as almost any country to infection from China. That's one of the things that the network scientists at Northeastern University have shown, and I quoted that in my Wall Street Journal piece. We are very integrated, the United States, and particularly the West Coast, into China, and so a lot of people came here from China in January and even into February. The probability is that we don't have hundreds of people with the virus. It's more likely thousands, and in fact, plausibly tens of thousands. So we still don't know that, and we won't know it for possibly weeks because there has been such a shortfall in testing. But everything we know about network science and epidemiology tells us that it's highly likely that some parts of the United States will have a South Korean, if not an Italian-style experience. And so it's very early in the game in the United States, but you have to look at what's happening in those countries and project forward a few weeks and imagine the United States in that situation. Anybody who's not doing that is living in the same box that President Trump is in, as Jim Cramer just mentioned, telling themselves, oh, it's no worse than the flu, it's just going to be the flu. That actually is completely wrong because the mortality rate is likely to be significantly higher for the flu, and we don't have the kind of herd immunity that we have to influenza. We don't have the kind of vaccinations that we have for influenza. This is a new coronavirus. It is not the flu, and therefore its impact, as we've seen in the rest of the world, is likely to be really quite considerable, particularly for elderly people.
Yeah, you mentioned the president's response, Neil. It's something I wanted to ask you because I know in all of your work as a historian and an author, you've looked really closely at leadership, and you've said very positive things about President Trump in the past. So what do you think is the disconnect here between what we're getting from the administration, what we're seeing in the markets, and what the truth actually is?
The test of any president is the crisis. And what's been a striking feature of the Trump administration has been that actually the crisis took until the year of his re-election to happen. If you look back, let's just take the presidency of George W. Bush. You can see two quite different effects. 9/11, which was a huge shock, in some ways comparable to the shock of COVID-19, led President Bush to show his greatest strength, actually. The response that he gave, defiance, leadership, vengefulness, resonated with the American public and helped the U.S. overcome that shock. It also made him very popular. But when President Bush was hit by the financial crisis in 2008, he looked clueless and his popularity imploded. Luckily for him, he wasn't up for re-election because he'd served 2 terms. Or look at his handling of Katrina, which happened in 2005 after he'd secured a 2nd term. If he'd flunked Katrina the year before, if that hurricane had struck New Orleans 2004, he might have been a 1-term president. I worry that President Trump has got on the wrong side of this, that the line he's taking, tweeted out again today, that it's just another influenza, is going to come back to haunt him in this election year. And I'm afraid it's just not in line with the science of what an epidemic like this, indeed a pandemic, which it is in all but name, does, not just in terms of mortality and sickness, but also in terms of the effects that it has on public confidence. And I think when you look at what's happening, not only in Asian economies that have been affected, but also in Europe, you see that the effect of consumer confidence tanking is really very profound economically.
So Neil, what about President Xi Jinping then? I mean, to what extent? I know we don't get very trustworthy opinion polls coming out of China, but to what extent would opinion in his leadership have fallen? And where do you stand on how big the economic impact is going to be on China?
Well, the economic shock was very great indeed, as you could see in the PMIs, really unprecedented declines in economic activity because of the quarantine measures that had to be imposed on Hubei and indeed the restrictions on movement in China as a whole. The line that they're now taking in Beijing is that we're getting back to normal. Hubei is going back to normal. It's early to be doing that, and there is a significant risk that you get a second wave of infections. But I think what's happened is that China's leadership bungled this in the first phase, really denying that there was a crisis until it was very far advanced in Wuhan and Hubei province. But then, because they have a one-party totalitarian regime, they were able to impose the most drastic quarantine that I think there has ever been in human history. What I don't think is going to happen is that Western democratic governments are going to be able to replicate that. Even although they're trying in Italy, it's very hard for a democracy to do what they did in China. So I think the big question, which, as I said, is still in the realm of the unknowns, is how significant a problem is there going to be, not just in Washington state, in California, but potentially in New York, and indeed in other states that already are showing signs of having the beginnings of that exponential growth in confirmed cases that we've seen in so many other countries. If you get something like South Korea or Italy, it's very difficult for the United States to act like Xi Jinping and quarantine a state. And that, I think, means that the response in democracies is likely to be less drastic and therefore less effective than the response we saw in China.
Neil Ferguson, as always, thank you very much.
My pleasure, Wilfred.
And don't forget, tonight, tune in 7 p.m. Eastern Time, a special Markets in Turmoil. Again, crucial viewing amid this crazy volatility.
Let's go back to Mike Santoli for the third dashboard of the day. Mike.
Yes, I wanted to zoom in on a couple of sectors of the market or styles of investing. Take a look at the Invesco Buyback Achievers ETF compared to the S&P 500 itself. This is only over 6 months. And you see really this vertical move down, vast underperformance for the buybacks. Like now, one of the things that kept the buyback story afloat, of course, was corporate debt markets being in good shape. Now you'd have a lot of financials in this buyback ETF as well. But that's a theme that seems to have been derailed, even if perhaps it was over-credited for its force on the way up in the bull market. Take a look, too, at the transports. We did kind of glimpse those earlier, but this I like goes back to 2015. We are at levels on the Dow Transportation Average we first reached 6 years ago. So it's not just that, oh, we've kind of hit the skids in the market and the tariffs and all the rest of it. You have to basically, you're down on a 6-year basis here, a 5-year basis, and you even have to go back further to 2014. FedEx down to levels seen 6.5 years ago. So clearly, you've really stripped away a lot of expectations for what global growth can produce for this sector. Is it enough? We simply don't know. You have overshoots to the downside as well as the upside in markets.
Mike, thanks very much for that. We will dive into that analysis in a moment. But first of all, breaking news. Steve Leisman's got it for us on the Fed. Steve.
Thanks very much. Well, 6 financial regulators, including the Federal Reserve, the FDIC, the controller of the currency, urging some regulatory relief or supervisory relief for banks, for businesses and credits affected by the coronavirus. Regulators say banks should work with their customers in affected communities and to basically talk to them and try to work things out over time. This is very similar, Wilf, to the kind of guidance that we get in an area after a hurricane or other natural disaster. Something we talked about could be coming from the regulators a couple weeks ago, and now they're out with this saying, work with your borrowers and work with supervisors to try to get over the hump of whatever credit problems might ensue from the coronavirus. Sarah?
But Steve, bank stocks, I can't remember off the top of my head. Bank of America was down 15% today. It was down close to 40% from its February peak. Is this essentially saying banks should take the hit in the short term?
No, here's what it's saying.
The government's going to help.
Well, you've seen these before. They have done this many times before, and you've seen these, where what they say is if a borrower is having trouble making a payment because of the virus that's out there, or in other cases of the hurricane, the supervisors are not going to swoop in and penalize you for not taking action on that bad credit that's in place there. This is a situation where they're saying, we're going to provide supervisory relief or supervisory oversight, where we're going to say, okay, you guys, that is okay for now. I mean, if we get a year from now and it's still a bad credit, we're going to penalize you, but we're not going to do it now.
All I would say on that, Steve, I totally get your point, is that kind of expectation sort of goes without saying. It's not like this is a groundbreaking shift in support. Not that you're framing it that way anyway, in a way that I think markets are waiting and looking to hear from as to whether we actually get genuine help from the government to say, we will make sure these companies don't need to let the banks down, if you see what I mean.
That is a very different story, Wolf, and you and many other people, including members of the Federal Reserve, are waiting for that from the fiscal side. The Fed here doing what it can do, and I would just offer, if it didn't need saying, that I don't think they would say it. Apparently, this is an important piece of the whole regulatory framework for them to step forward and say, don't worry about this.
I think the Fed is in its crisis playbook here, and the federal government is not. Is that what's happening?
I think if you were to measure who is further down the line of thinking this is important and they need to act, certainly the Federal Reserve is taking substantial actions. And as you know, Sarah, they're expected to take much more substantial actions.
Steve, thank you.
Pleasure.
Our next guest says a credit crisis is more likely to trigger a global recession than the current stock market meltdown. Joining us now is Nouriel Roubini, chairman of Roubini Macro Associates and professor of economics at NYU's Stern School of Business. Nice to see you.
Great seeing you.
What are you worried about with the credit market?
Well, the stock market has a wealth effect, but since there is a massive amount of inequality, even a 20% fall in the market is not going to lead to a recession, while I think that the seizure of the credit markets has a much more severe impact on the economy. You saw what happened, in 2016 or 2018. We have leveraged loans, we have CLOs, we have $1 trillion of fallen angels in high grade, and we have all the junk bonds in high yield. In 16, spreads went from 300 to 900 in a matter of a month. If they'd stayed there for 6 months, the Fed believed they will have a recession. This time around is worse because at that time, first of all, you had only a growth fear. Right now about China, US, right now it's much more serious. China is going down, the rest of Europe, US is going to go down. Secondly, it's not just the oil market. At that time, oil went to 30. Right now it's below 30. And it's not just oil, it's all the service sector is highly leveraged. It's going to be in trouble. There is more debt. You have all the situation of SMEs and households that are illiquid but solvent, but if they don't get debt relief, they're going to be in trouble. And we've had 3 more years of increasing debt and leverage in the system and the corporate sector. And compared to 16, the room for the policy response is much less than before. We're running out of bullets. So you put it all together, is much worse than what happened in the first quarter of 16 or the fourth quarter of 18. It's going to be much worse. And the trigger for the recession is going to be the stock market, but the credit crisis. And we're in the beginning of a complete seizure of credit market. There is no issuance in the primary market of leverage loans, of CLOs, of high yield or high grade. It's totally shut down.
So worse than 2016, you're saying?
Much worse.
Will it be as bad as 2008? What level of recession are you now expecting?
Well, first of all, I expect there's going to be a recession because Q1 growth in the world will be for sure negative, given you have negative growth in China, in Japan, in Korea, in Italy, and US will have barely 1% growth, and the Eurozone closer to 0. In the second quarter, given what has happened in China, you're going to have a spread of the contagion to Europe and to the United States. The numbers are fudged down because we're not testing. We know that in the countries where we are testing, the numbers are huge, like in Italy and Korea. Why in the US they are so low and you have high mortality rate? Because we're not testing. Probably we have already 10,000 cases. So in the second quarter, if you have what happens in China, in Europe and United States, you'll have the same situation of a severe economic downturn in the second quarter. So first quarter because of China, second quarter because of US and Europe. And probably in US and Europe it's going to be worse because China had draconian big brother society types of quarantine that we're not going to see in US or in Europe. So most likely in China it took 3 months to stop and reach a peak of the contagion. In Europe and US could take 2 quarters, and 2 quarters means you'll have recession in Q1, in Q2, and Q3. And it takes only 2 quarters for having a global recession. So we'll have for sure a global recession. The question is how severe it's going to be.
Nobody's talking about a credit crisis at this point yet, Nouriel. Yes, we've seen a big move, but I mean, what I hear from people is it's not panic, it's just dislocation. There is price discovery. This is an early move, and a lot of it today was energy related.
Well, in 2016, it started as energy, but in a matter of a few weeks, you had contagion from energy to the rest of the high yield. Why? Because when you take losses on energy, you have to cover yourself on the rest of the high yield if you're an investor. And this time around, the shock is not just on energy. You have all the high leverage firms in the corporate sector, especially in services, going down. So there is a fundamental reason why the entire high yield should go down. And in this case, it started from high yield, then leveraged loans, then CLOs, then it goes even to high grade, where you have $1 trillion of fallen angels, of firms that used to be high grade, but now they're borderline, they're going to be downgraded to below investment grade. And then it's going to go from there to emerging markets, local currency, foreign currency. As this movie has happened before, the difference, I said, there are 5 differences compared to 16, is much worse today than 16. We're not yet in the debt crisis, but we're at the beginning of a debt crisis. It's the beginning. There's seizure in the market is shut down. Nobody can issue, not even the high grade folks. So if this is not a crisis or a beginning of a crisis,
this is why they call you Dr. Doom.
No, it's not Dr. Doom. It's not Dr. Doom. It's Dr. Realist. I mean, I'm speaking about what's happening. I'm not speaking about something hypothetical. What's doomish about it is the reality of what's happening right now. Let's not use stereotypes, Dr. Doom. It's silly.
No, sure. Why do you say that the room for policy response is less now than 2016, when we had Fed funds rate was at under 0.5% then, now we're at 1%. And, we have the same tools as then. Obviously, though, the rest of the world perhaps in a different spot.
Well, the policy rate is almost the same here as before. In the Eurozone and Japan, the policy rates are already very...
now. It was under 0.5% in early 2016.
Yeah. So we're going to use that one. We might use it actually by another 50 basis points by March 18. And things are going to start to be bad only then. During the global financial crisis, we were at 650 and went all the way down to 0. And then we had to do forward guidance and then QE and then credit easing and other things like all the things we did with all the unconventional liquidity things. This time around the world, the policy headroom is more limited than before compared to the global financial crisis. That's a fact, and we know. And we'll see once we go to 0 whether they want to do QE or whether they want to do more convention. By the way, given the supply shock and it's partly demand, we know that monetary policy alone is not going to be sufficient. You need massive fiscal stimulus. Take the United States, let alone the rest of the world. There is gridlock. The administration might want a tax cut or a payroll tax cut, and Democrats are going to say, fine, we'll do it if you raise the taxes on the corporate and the rich. They're going to pass it in the House. It's not going to pass in the Senate. The gridlock. Why would the Democrats give this gift to Trump on election year? They're not going to do it, and this growth implies that any fiscal stimulus in the U.S. is going to be tiny compared to what's desirable. People now start to talk about coordination between monetary and fiscal policy. Stan Fisher, Ben Bernanke, this morning, the Redalio on the FT. What does it mean? It means helicopter drop of money. That's a term, right, for helicopter drop of money. You need fiscal policy, and then you have to monetize in the primary market. How likely is that's going to happen? That you have a fiscal stimulus that's going to be immediately monetized? It's maybe the right thing to do, but it's not going to happen. It's not going to happen.
If the S&P 500 down 18% or so from its highs, you think further to go?
Yeah, further to go. A typical recession, the stock market goes down 30 to 40%. During the global financial crisis, it went down by at least 60%. Of course, it's not going to be a linear down because as things get worse, tonight the Fed might actually take some action overnight, not cutting rate, but maybe providing more liquidity or extending the purchase of T-bills from April until the end of the year, or ease the discount window, or create one of these term auction facilities like they did in 2008. I'm sure they have to do something overnight. What they just announced right now with forbearance for the banks is not going to be enough. So the market can rally for a day or two. Then things get worse because the fundamental implies that in the next few weeks, the number of cases is going to explode. That's the fundamental. People are going to panic. And then you do it incrementally more, and there'll be a talk about the little fiscal stimulus, $50 billion, what's that spare change, $100 million, not enough, and so on. And therefore, things are going to get worse, and the policy response is going to be less than desirable and optimal. Therefore, the market can go down 30% or more before they bottom out. The trend is going to be down, and it's going to be a zigzag. It's not going to be linear, but the trend is down. It's not up. We have not reached the bottom based on the fundamentals, and the policy response is not sufficient. So if you extrapolate, it has to get worse before it gets better.
Do you think negative rates are possible in the U.S.?
I think that the Fed, when they're going to do their Fed review, they're going to say, as they have said, yes to zero rate, yes to QE, yes to forward guidance. We don't want to go negative for a bunch of reasons. Some people within the Fed favor, like in Japan, a yield curve control, zero rates on the long end, like Leo Bryan. Some people like Rosenberg are talking about buying private assets like stocks and so on. I don't think that's politically feasible, and you have to pass legislation. So you'll have a bunch of things to do, of course, including QE, but it's going to occur too late, too slowly, and it's not going to be sufficient because you need the fiscal side to be big, and then the monetary is going to finance it, and we're not going to get a big fiscal stimulus. You need at least a 1% of GDP or maybe more of a fiscal stimulus. What is the chance we get that one before the election? I would say close to zero. $200 billion? No way it's going to happen.
I guess let's see what the market does. Maybe they can force the hand like we've seen in the past. Nouriel, thank you. Good to see you.
Good talking.
Nouriel Rubini
prefers the title now, Dr. Realist.
Dr. Realist.
We won't use Dr. Doom, but you must accept you're not Dr. Optimist as well.
I'm Dr. Realist.
Okay.
There are sometimes to be optimist, there are times to be pessimist.
We need to
right
see
now
you
is
more
the
during
time.
the
It's nice
time.
to end with a
safe,
smile, regardless.
Yeah.
Anyway, Nouriel, thanks so much for joining us. Crazy move. So let's have a check in there on the Dow, how we finished down 7.8%. Dr. Realist striking the right tone if we have repeats of today. Walmart even falling into the red as well at the close. It had been green for most of the session, but all 30 stocks negative, and plenty there at the bottom of double-digit decliners, about 7.
A 2,000-point loss for the Dow, worst day since the financial crisis. Let's get the latest details on how the White House is responding to the coronavirus outbreak and the market meltdown. Eamon Javers with us from Washington. Eamon.
Well, White House officials tell me that meeting with the president and his economic team did begin around 4:15. They told me it was underway here, so that is ongoing. The president is set to be presented with some options for how to respond economically to the coronavirus. Not clear where the White House is going to land, and aides were careful to caution me today to say it's not necessarily guaranteed the president is simply going to pick from a menu of options and make a decision today. We will wait and see what happens when they emerge from that meeting to see if any direction is being set out upon here from the White House. Meanwhile, as the president's making those decisions, congressmen who have been in contact with the president over the past 2 business days are now being self-quarantined. Congressman Matt Gaetz, who was with the president on Air Force One this afternoon, has announced that because he came in contact with someone who potentially had the coronavirus, he is entering self-quarantine. That self-quarantine began after Gaetz got off Air Force One with the president this afternoon. Congressman Doug Collins was with the president on Friday in Atlanta at the CDC. He also now under self-quarantine. Neither congressman, we are told, has any symptoms of coronavirus, but that's sort of what's swirling in the president's worldview as he sits down to have this meeting today. People he's been in contact with are now under self-quarantine. And guys, we're expecting a series of meetings later on this week. Health insurance executives are here tomorrow to meet with Vice President Pence. And then on Wednesday, Wall Street CEOs will be here at the White House to meet with the President of the United States. All of that formulating a response from the private sector in terms of what to do on coronavirus and what kind of help they may need from the federal government, guys. Back over to you.
So, Eamon, you know, as the market was plummeting today, the president was tweeting. And this tweet in particular, I got a lot of commentary about. So last year, the president says 37,000 Americans died from the common flu. It averages between 27,000 and 70,000 per year. Nothing is shut down. Life and the economy go on. At this moment, there are 546 confirmed cases of coronavirus, 22 deaths. Think about that. In other words, continuing, I think, to downplay the severity of COVID-19, the fears in the market, the fears from ordinary Americans. I mean, what is anyone telling him, Eamon, that is completely disconnected with what the market is telling us and what we're hearing from healthcare professionals?
Look, I tried to get a question to the president in as he came into the White House this afternoon. He did not stop to talk to reporters about the market sell-off today. He did bring Brian Urlacher, the former Chicago Bears player, into the residence with him. So he's having a social visit here just before the meeting with the economic team. And look, the president's getting a lot of advice. He sees what's on television. You talk to White House aides, they say, you know, you just don't even need to brief the president on what's happening in the market because he sees it in real time. And I think clearly the impetus behind that tweet is he doesn't want to panic. He wants to put all this in context. But the danger politically is that you do look potentially out of touch, and you look like you're not taking this with a sense of seriousness that it deserves. The president was in Florida today having a fundraiser, for example, not here at the White House until this afternoon. So all those optics matter for a White House and for a presidency. And of course, as we know, these kinds of emergencies, public emergencies and financial emergencies can be life or death stakes for politicians politically in the White House.
Eamon Javers. Eamon, thank you.
You bet.
Take a look at shares of Stitch Fix after hours plunging on earnings. Kate Rogers with the story. Kate.
Hey, Sarah, that's right. Stitch Fix down just about 37% right now. That's on a really mixed quarter here for Q2. EPS a beat 11 cents versus estimates of 6 cents. Revenues, though, a miss here, $451.8 million versus estimates of $452.5. Now, Q3 guidance here on revenues is a bit lighter than expected. The company's saying they believe there's heightened promotional activity across retail and that clients wound up spending less per fix in the current quarter on average, resulting in lower order values than the company had anticipated. They also said they have 3.5 million active clients. That number is up 17% year over year. And also just finally mentioning coronavirus is a fluid situation that they're monitoring, but right now no material impact on their business. That conference call kicks off around 5 p.m. and we'll bring anything else we get. Back over to you.
Can we go there?
Kate Rogers, Kate, thanks. Down 37%, Mike, gives us a taste. I mean, they didn't blame coronavirus, but it gives us a taste of what the action is going to be around earnings season.
Yes, maybe an extreme example, I would imagine, but this is not the kind of market where you have kind of a show-me story stock that hasn't yet proved it can sustainably, grow into its expectations, going to disappoint like that.
Just want to bring some other news. The Italian Prime Minister just giving a live address moments ago and announcing that the restriction zone will be extended to cover the entire country. No longer just a red zone in the north of Italy and the Lombardy and surrounding region as it had been. The entire country is now quarantined in that restriction zone. I mean, Mike, we talked earlier in the show, clearly the oil news was a huge part of the story over the weekend. I think seeing a Western democracy move to the sorts of draconian measures that we'd seen in China had also been a big piece of news over the weekend that surprised the market. The entire country, that is quite astonishing.
Right, absolutely. And also the fact that everybody here knows in the U.S. cases are going to go up. We're just on the front end of this spread. But the idea that it could get out of hand and that we're going to be living with this drumbeat for a while, I think is a significant thing. Now, at some point, I keep saying the market is just going to overshoot to the downside to price in a pretty dire scenario that might be a little bit worse than the probable one. So we just don't know where we are in that process right now because we don't have enough numbers in terms of tests to draw the curve and to say we know what we're looking for in terms of the numbers rolling over.
By the way, the Italian stock market today dropping 11% on that, the idea of that lost economic activity.
Yeah, but to that point, I mean, the Dow Jones is down 8%.
Yeah,
so,
I guess so.
I mean, just enormous moves all around. And just whilst we bring that up, China was only down 3%. Again, China stands out as really not having fallen anywhere near the level you might expect given the likely economic impact. But again, we've talked about all sorts of sectors that have been hit, banks and energy stocks the most. And clearly, if you're looking down a whole country, it's understandable why those sectors have been suffering.
Makes other European countries also probably rethink those open borders.
I'm sure it does. And just to come back to as well, we talked about the way in which U.S. banks have been hit. Deutsche Bank, since its February high, fell 46%, I think it was, to the close. Now, it had a very strong run December into January, February before that, but it closed at or around all-time lows. So again, similar types of movers in European markets, similar types of sectors are taking the brunt of this, some extraordinary moves globally all round. Let's check in on some of the travel stocks, which, as we mentioned, have been in the eye of the storm. Travel websites down more than 5%. Trivago getting hit the hardest, down 17%, as you can see there. Bookings, Expedia, TripAdvisor all down over 5%. Our next guest says this hit to travel could also hurt ad-driven tech businesses like Facebook and Google. Laura Martin joins us now. She's a media internet analyst at Needham. Thanks so much for joining us, Laura. So talk us through it. The likes of Facebook and Google, perhaps more linked, do you think, to the coronavirus travel restrictions than so far has been priced into the stocks?
Yeah, so travel advertising, this is their peak period for advertising in anticipation of people traveling during the summertime. 70% of all travel advertising is online, and 70% of that is in search. So Google is the big loser there, both in March and in the June quarter. We took numbers down. But Facebook is not only exposed to travel, it's also exposed to CPG and retail and entertainment, like the James Bond film being pushed off lowers advertising by 50 million, just that film being pushed from sort of near term to November. So that's about those four categories that are already showing lower advertising demand are 45% of total digital advertising in the US and 30% globally.
Do you think it's already in the stocks, Laura?
No, because I think people are underestimating that when you have a revenue downdraft, they are 70% margin dollars. So there's a bigger profitability hit than people are thinking. And you probably saw that Microsoft, Facebook, Google are doing the kind and humanitarian thing. They are going to pay all of their hourly workers who aren't coming to work anymore because they've sent everybody home. So that's going to be great for the local economy, but it's going to really blow up their income statements even more than the downdraft in their revenue.
Laura, when you assess these stocks that you've covered for so long and know so well, do you think about the price to earnings multiple relative to the rest of the market? And do you adjust what's reasonable at moments like now when fear is spiking? Traditionally, these guys have had higher multiples, but when things are calm, that can be argued to be justified because their growth is high. Does that go out of the window at a time like now, or does it still apply?
No, it sort of goes out the window right now because we don't know where the bottom is. You know, when we get to a bottom, when this coronavirus numbers stabilize either in the US or China or offshore, then we can look at where the bottom is. And at that point, we can assess what the corrections have been and start putting money back to work. But right now, there's so much uncertainty about the damage that coronavirus is going to do to consumer demand and to the market access, like, can you raise any money in the equity or debt markets right now? And for how long is the window closed? That we have to see where those relative valuations are once it bottoms and consumer demand starts returning.
Is there any name that's relatively insulated from this? For Twitter, I didn't hear you mention, for instance.
No, I would stay away from all ad-driven stocks, which are fixed cost businesses with 70% margins. We like Peloton because people aren't going to a gym as coronavirus fears escalate. And it's a subscription business, and they have 1% churn. So once you get one of these Peloton bikes for any reason, even if it's to not go to the gym for a couple months, you don't ever get off of it. So we really like Peloton as a defensive play in this market.
But are you going to go out and buy a Peloton if you don't want to go to the gym? Is that what's happening?
Well, I think people in our demo might be.
There we go.
I mean, we did see a move in the stock on that.
Defense. Well, it's down today, though. But Laura, thank you so much for that.
My pleasure.
Let's send it back to Mike for his final dashboard of the day. Mike, what do you want?
Yes, markets are kind of fully in the mode of trying to handicap just exactly how much of an economic slowdown we get globally. This is the Goldman Sachs current activity indicator, so it's meant to be a leading indicator of global GDP. Keep in mind, not just U.S., but global. In February, this is as of the end of February, it was barely above the zero line, around 0.5%. And when we're talking about global, that's a steep slowdown. It's, the world grows faster, typically than mature economies like the U.S. So that is basically foretelling a first quarter print for global GDP somewhere under 1%. I guess the question right now is maybe bond markets have adjusted to account for something like this environment. But how long would it have to last at that type of near zero growth level for stock markets to really adjust? That's unclear right now. And I do think this is what a lot of people are focused on right now. We were sort of okay with this idea that we had a pause. But if it's something longer than that, then we might have to end with it.
To the global growth question, Mike, I think we should come back to this announcement from Italy. Because the Italian Prime Minister says, on top of what we said earlier, that the whole country is now in quarantine, all Italians should stay home, think of the common good and play their part to combat this coronavirus, cancelling all public gatherings, all sports matches. I mean, the market was down 7 or 8% today, and you look at that and say, what level of news headline do we need to create another shock to the downside? That's pretty extraordinary, and it will also raise that question, what will other Eurozone leaders do if they start to see numbers pick up and they don't want to be blamed for not being cautious enough? I mean, this is an astonishing move.
We're going to have to interpret to see if that's going to be an outlier response or not, and how do we guess that? It's very difficult to guess that. Now, I do know there's a lot of commentary that Italy has the oldest population in Europe, and it does disproportionately. The deaths have all been 60 and over in Italy. So I do think that maybe that has something to do with it, but it's certainly a little bit
I get that they have an aging population, but I'm afraid so does France, Germany, the UK, and the US. I mean, it's not like the demographics are attractive in any of those places. I do think the other theme that has come out from the commentary that we have seen as well from Prime Minister Johnson and others is to try and ease the pressure on health services in the short term and hope that they can manage it that way. But so far, only Italy taking this action, and clearly their numbers are much worse as well. so far.
When's that ECB meeting? On Thursday? That's going to be a tough one.
I mean, but to that point, we're saying the Fed perhaps might announce more overnight or whatever. What on earth is the ECB going to announce? What can they announce? It's almost lose-lose. Deutsche Bank's collapsed 46% in the last month. If we go negative rates, that's going to go further.
There's always tools in that toolbox.
I'm not sure there is.
We'll see if she can come up with something.
She magicked something up from nowhere, perhaps, but I'm not sure elsewhere. Let's have a look at how we finished the day on Wall Street. As we've said already, record decline in points for the Dow ever. In percentage terms, both the Dow and the S&P worst declines since various dates in 2008. 7.8% on the Dow, 7.6% on the S&P 500, 7.3% on the NASDAQ.
Incredible numbers. Will tomorrow bring more pain or relief rally? Bob Bassani is looking at some ETFs that may give investors clues.
Yeah, unfortunately, we don't have a lot of direction. Futures are still trading here. Just look at the S&P 500. SPY here still trades, closed at 274.23. I see it right now, last trade at 274, a little bit below that, 274 right now here. So let's call that relatively unchanged. Diamonds, Dow Jones Industrial Average is the ETF for that. Closed at 238.72, now trading at 238.20. Again, very, very modest decline from the 4 o'clock close, and the triple Q 193.57 is where that changed hands last at 4 o'clock Eastern time. You see there 193.30. So modest, very modest decline so far. I agree with you, Wilf. I think these comments from the Italian the heads of state in Italy are absolutely remarkable at this point, and still not seeing a dramatic move, though, here.
Do you think that was priced into the market today, that we're expecting that to extend?
No, I don't. And I think that's quite extraordinary. I agree with your point here. So these are like rolling headlines. We're trying to get used to all of this on a daily basis. I think the only good news today is we did have that initial shock with the circuit breaker, and it served its purpose. The purpose was not to change the headlines. The purpose was to slow the market down for 15 minutes, gather liquidity, and it did that, and the market did lift, even though we closed at the ends of at the lows at the end of the day.
So, Mike, what are we watching overnight?
Kind of reminded of Michael Hartnett at B of A has a saying he always goes back to, which is markets panic until policymakers panic. Maybe that's the next thing we're actually trying to hook ourselves onto, because over this phase, we've been able to say multiple times.
And it's not going to be the Fed this time, right?
Well, I think partially, but perhaps not all. I think the real policy response people are wondering about is congressional, is fiscal.
What do you look at overnight, Mike? I mean, Asian markets, obviously, but oil prices.
Asian markets and obviously yields. I mean, it went unremarked today largely that the Treasury yields did have some lift throughout the day. It's been a real sucker's game to try and call the final buying climax in Treasuries, but that is something to watch because they do trade, more or less throughout.
I think what we're going to have to watch for tomorrow. Obviously, we're not going to get a bottom in coronavirus stories, but some kind of indications of massive fiscal stimulus. I think the market would be much more impressed, and not just for consumers. It's not the consumer doesn't have money. The consumers have money. They're scared. Corporations need assistance as well, and I think that might help provide some kind of at least short-term.
Well, we're all going to be watching over the next hour Fast Money, which is about to start. Brian Sullivan here with us now, Brian, where really the heart of it all today was that shocking oil move, down 25%?
Yeah, you guys have noted, I mean, the biggest one-day slide since 1991. But again, not to belittle it, or belabor it, it's people say, well, who cares about oil? It's good, right? Gas prices are cheaper. The problem, of course, as I know you guys have talked about, and of course, Wilf, you cover the banks, it's really a debt and a credit story. It's an oil story as well. Oil, a small part of the stock market, but a much larger part of the credit markets.
Absolutely, Brian. I mean, it could become a debt and a credit story. I think that's the key question for the banks. They've fallen sharply like the oil companies, but as yet, unclear whether they warrant that level of fall or whether we'll see those types of debt issues. Either way, down sharply today. And Brian, we know you'll have all of the analysis covered. We're out of time here on Closing Bell. Over to you.
Yeah, we'll try to get some rest tonight, guys. We'll see you tomorrow morning. Nice and early, Wilf and Sarah. Thank you very much. All right, everybody, welcome to Fast Money. I am Brian Sullivan, and your traders on this very important night tonight are Tim Seymour, Steve Grasso, Karen Feinerman, and Guy Adami. All right, we're going to get to that in just a second. It was, meantime, a record day on Wall Street, and for many, a day to forget. All three major averages plunging more than 7%. The Dow, the biggest loser, falling 2,013 points. That is not a misquote. That is the largest point drop ever and one of the top 10 biggest declines on a percentage basis ever. The transports crushed, falling nearly 10%, their worst day since all the way back in September of 2001 on 9/11. Obviously, don't need to remind you what happened then. Today's losses fueled by that crude crash that we just discussed. The energy sector having its worst day ever as well. Oil losing roughly a quarter of its value. Crude is now trading just below $31 a barrel. Many oil and gas stocks down 30 and 40% today as the market assesses simply many of these companies' ability to survive in a lower oil-priced world. And one more incredible stat for you on this incredible day. Interest rates continue to collapse. The yield on the 10-year Treasury note hitting a new low of nearly 0.3%. Well, following yesterday's sell-off or today's sell-off, S&P 500 stocks have lost a total of $5.7 trillion in market cap just since the record high on February 1st. There is your setup. It was, by any measure, an historic day. Guy Adami, I know you were on Power Lunch as well. Welcome, everybody, on this big day. We are commercial-free, by the way, through the entire hour. And this is a night, Guy, where we don't need to really get complicated. It's a question of what happened and what do we do now? Do you really believe that the drop in oil is what triggered this market today?
Well, it's obviously a big part of it. You can't discount the fact that when crude moves to the extent that it moved, given the moves it already seen, it obviously had a lot to do with it. And that's stoked the fears as well. But again, a lot of this has been in place for quite some time. You know, bond rates, the bond market shouldn't move like it's moved over the last year and a half. And I'm not saying that today. We've been saying that for quite some time. The volatility in the bond market was striking. Nobody really talked about it because it's not equities. You know, if we had that kind of, half that kind of equity volatility, it would be front page news every day. Currency is the same thing. Tim speaks to that all the time. Now it's finding its way into the equity market after a long period of time. I happen to think, as painful as this is really a good thing. The market needs this. I'm not suggesting it's over. I think you know when it's over, and this is just my opinion, when you see some big either hedge fund or derivatives book or some sort of bank with a huge derivatives options plays, when they blow up. When that happens, we're close. It hasn't happened yet.
I saw some data today, Tim, that in some ways average volume was higher than during the peak of the 2008 collapse. The action was fast and it was violent.
Dollar volume certainly would be based upon the levels we're at in the market. But the velocity of this, pick your asset class, every single one. So, you know, to the intraday low on the S&P, we were down about 19% in 12 days. Guy mentioned the reference to the dollar being down about 5.2% in 12 days. The yen strengthening, which we all know is kind of this unwind of carry trades. That's part of the dollar's move, by the way. And without getting too lost in that, those are, you know, that yen move is a massive risk off move. That's almost 10% move in the yen in 12 days. So, look, there's different fires going on around the world and in different asset classes, frankly. And I think oil over the weekend was the latest black swan in the middle of, you know, what might be a group of foul. There is a credit dynamic that is emerging out of the energy space that we all knew was there. And if you talk to credit traders in energy and in high yield, they'll tell you that actually, you know, where they're seeing the market right now is inside of the lows of 2018 December and more likely nearing the lows on spreads right now of 2015.
And we'll get to more on energy with Mike Bradley at TPH, one of the best, if not the best in the business. But, Steve, I want to start off with you. And we had a circuit breaker hit. Right. It fell 7%. I think it was 3 minutes after the open on the S&P 500. Stopped for 15 minutes. What was that like? You're on the floor. What was that
Panicky.
like?
It's not every day you deal with a circuit breaker. And you
had it
had
3 times in 20 years or something like that?
3 times. And when you have it telegraphed, where last night we're limit down the futures, that was a big deal. And everyone was waiting for us to get dropped to the next level, which was down 13%. So I think we're starting to see shades of panic. But I'd rather have this panic in the oil market than in the financial markets in the banks, if that makes any sense.
Didn't we have that today a little bit?
You had it, but there's not a balance sheet panic. There's a stock price panic, and I think those two things are completely different.
Yeah, because, and I think we have a graphic on this. Goldman Sachs put out a note late today that I got, and it's basically energy's exposure to the banks, and it's small. I think Citigroup was the highest
3%.
at about 3%. You've got Bank of America at about 2%. So on an absolute basis, Karen, we're talking about a fairly small portion of the balance sheet.
So I don't think that's
Or their
really what
loan
was
books, I
going
should
on
say.
today. I mean, the market was down, so of course everything would be down. I don't think it was oil. I think it was more this idea of rates, of course, that always, is difficult for the banks, but this idea of a recession and credit quality. And what does that mean if we have a slowdown? What does that mean to their entire book of lending? Forget oil. The rest of their lending. If you look, Bank of America, I think, is maybe among the hardest hit. They have a very big consumer book. So that's what I think, aside from the market, aside from rates, aside from oil, which really is the last one, the smallest element of the move.
Because take us into that, because I think this is a really important point to make, because it's not just about the move today, it's about what happens going forward. There's the data. Citigroup, 3.2% of their order book, according to Goldman Sachs, Wells Fargo, 1.5%. Those are small numbers relatively, but we're still talking $15 and $16 billion in the case of Citigroup or maybe JP Morgan Chase. And so is the idea, Karen, what you're talking about, if those things start to suffer, the chance of them lending money to businesses, giving you a mortgage, all that stuff starts to shrink a bit.
Not because of the oil exposure, I don't think. Because of the rest of the book is so much bigger that, if you're going to have businesses that are really starting to have trouble, that's, I know JP Morgan, all the banks want to be, they want to be a good partner, but at some point, you don't want to extend credit that you don't think you're going to get back. So that's what I think was weighing a lot, plus rates and a market that was down.
And I think today was the big fear day, right? I mean, everyone felt afraid. You had so much of that set up last night when you're watching the futures limit down. And then when you hear Governor Cuomo, though, I think he put it in perspective rather well when he said we're battling more fear than the virus. And I think we're not scientists, we're not MDs, but to me it seems like the market's trying to factor all of this in, and I don't know where the chips finally fall, but it seems a little overdone to me.
Well, listen, Steve, fine, but we just had, you heard Wilf and Sarah say it, that the Prime Minister of Italy is trying to shut down the entire nation.
Right. I think what you're
hold on. It's the ninth biggest economy in the world.
So let me just real quick. So I think what Wilf is saying, though, too, is that countries are trying to outdo each other with what they're shutting down. It's the same thing with S&P 500 companies. They're shutting down visitors. They're shutting down cafeterias. And if you don't shut down, you seem like you're being cavalier, and God forbid something happens and you're to blame for it.
Yeah.
So I think we're in a race to shut down the world right now.
Fair enough, but that's not for us to judge here. Our job here is to analyze the economic backdrop, Guy Adami, and say, if we see a significant reduction in travel, driving, commuting to work, an economic slowdown, we have no idea what growth rates are going to be, if we have growth, and what corporate earnings are going to be. And maybe this is a stock market that reflected the idea that simply they don't know anything.
Yeah, I hear what Steve is saying, 100%. And we have a lot of time, which is good. I mean, I think the coronavirus, a lot of people say it's the cause. That's fine. Everybody's entitled. I think it just was sort of the final match on what has been a tinderbox, and that set it off. With that said, the S&P 500, I think at today's close is down 19 or so percent from the recent all-time high. It's a pretty big number. People will say the market's cheaper now. That might be true. I'd push back and say I can make an argument, and I'm not, again, I don't know this, but I can make an argument that stocks might actually be more expensive today than they were at the all-time high.
Because we don't know any of the multiples.
How can you possibly, now I'll say this quickly, 73% of this economy is driven by people buying things, going places. People are not going places. Listen, I want to go to my conference in Chicago at the end of the month. It got canceled. That's real. That's happening. So I don't think we can sit here and say, I don't think anybody's trying to do it, but we have no idea what's going to happen to earnings.
And 165, 166, which is where we were last year and where consensus is. I mean, first of all, I think we're lucky and I'll leave it ultimately to the strategists that are making a call on S&P earnings, but you can't tell me we're going to grow 3 or 4% and in a revised downward. I mean, we're talking about a major contraction.
Tim, do you think we contract?
Yes, I do think we contract. And that's even in the construct that we're in now. So, Guy, we're all talking about the lack of uncertainty about the duration of this. The other thing I bet the market, and I think we're all saying this, what is notable to me, though, despite what's implied on coronavirus here is that I don't think today's move in the markets felt very coronavirus at all. We weren't really talking about the virus. We weren't talking about politicians around the world. Yes, Italy took northern Italy and basically quarantined it. And yes, New York State and other states are doing dramatic things. Schools are closing. But the market's move was set in motion by OPEC and Saudi, basically playing Russian roulette. And I think Putin's got an ability to play this game longer than the Saudis do. And this is the construct in which the markets came into today. And then it's the credit. And then it's the dynamic that we're all talking about with different asset classes. Yes, Corona, of course. But what was interesting to me about today, as we get deeper into news flow on Coronas, the market wasn't trading on Coronas to me. It just wasn't.
All right, let's talk more now about today's big sell-off. And more importantly, what now? What do we do? Joining us on the CNBC Newsline is Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, was today the bottom?
Well, I think it's really close to at least a bottom, Brian. I think to capitalize on a little bit of what Timmy said, the yen's move today was extraordinary. So if you look at the 10-day rate of change on the U.S. dollar-yen relationship, it's worse than it matches the worst of '08. And it happened on actually October 27th of 2008. And obviously that wasn't the low. It was a low. You actually had a significant rally off of that level. So as I wrote last night, the market is set up because of how wild the movement is in the various asset classes. I could look at the VIX, the 10-week rate of change there, matches the worst of '08. Again, not the low, but a low. Same thing with the 10-year note yield, 10-week rate of change, most excessive in history by a long shot, and of course the S&P. So, there has been a significant drop, but it also isn't historically unique.
Connect the dots between what happened in the yen. I mean, people tuning in, we're fast money. We're talking about the stock market, but here we are talking about the yen twice in 7 minutes. What is the yen telling us? What does that mean?
It's just a flight. It's a risk-off trade. So think about the sentiment. When we downgraded on the show, we downgraded the market on January 20th. We have yet to upgrade it because of all the issues that the folks on the desk have talked about. But think back then, the sentiment was so positive. There was no real currency issues. The VIX was as low as it's ever been. The 10-year note yield was just kind of grinding lower, and the S&P was making a new high by about 0.5% every single day. And sentiment was just far too extreme. That's one of the reasons we downgraded. Look, just think of last week. People were thinking the market was going to correct, but they weren't bearish. The movement into these issues suggests that now they're getting bearish. Let me just give you the data. So last week, Investors Intelligence had 41% bulls, which is down pretty significantly from where it was over prior weeks at the new high. But there were only 20% bears. There's still, as of last week, twice as many bulls as bears. In 2011, it was 45% bears, 2016, 40, and 2018, 35. So I think this week is kind of flushing it to the point where you're going to get this wicked reflex rally.
Well, I'd like to see them redo that questionnaire on bull bear today, right now. Steve Grasso, jump in here.
So, Tony, when you look at this, I get airlines, I get the pressure there, I get the pressure on hotels, I get the pressure all around it, but are we going to make up for it in other segments of the economy? What do you think earnings are going to be? Because the market is a forward-looking price mechanism. What say you on that?
Well, earnings are clearly, I've been below the street for the entire year. I'm at 172. I think the street's at 174 or 175 for this year. I think I'm going to be too high. But it's really this. I'd love to make it a fundamental issue, and credit is always a fundamental issue. But this is a human nature situation, and that's how you create tops on human nature and you create intermediate-term bottoms on human nature, and then the fundamentals shake themselves out. So to put the fundamentals into the intermediate-term bottoming process, human nature gives you the whoosh. We got that. We're down 19%. The kind of oversold condition and asset class volatility creates what is typically a vicious multi-week reflex rally. This has kind of been our playbook for the last couple of weeks. That reflex rally ultimately fails historically because you start to get that negative economic data, that negative corporate earnings revision data, and it's at that demoralizing test of the lows that you want to throw offense aggressively back on the field. So that's our playbook.
Hey, Tony, a quick question just in terms of the other sectors that, so we talked about transports. Retail, if you take this back, and the XRT isn't a perfect measure, but it is certainly one measure of retail. You're back to April 2013, if you drew a line. Is there any part of this that you think is getting, maybe this is a different way of asking the same question, but there's certain things that have been beaten, and they were beaten coming into this. Is this capitulation moment?
I think it is, Timmy, and I think it is also for banks. I mean, look at the BK, the retailers, the banks, the SOX, all the semis. It's the Philadelphia Semiconductor Index. All of these areas are. I mean, the KBW Bank Stock Index, the BKX, is down 35% since late February, not since like years ago. So this is what, unfortunately, severe whooshes look like, and just to kind of. To put it into a context, Tim, so we can try and get in what it could look like over coming days. In 2011, we had an 18% drop over just a very few days. People forget about that. That was when Greece was going to fail. An 18% drop in a straight line over a few days. My friend Walter Diemer gave some context on that, on how volatile it got then. After that happened in August. After that, you had seven 90% upside days or consecutive 80% upside days. In other words, all of the volume was up. You also had 9 more 90% downside days in between that whoosh lower in August of 18% and the final low in early October, which was down 19.4. So we're set up for a ramp. Yeah. It could be in the retailers, the banks, the semis, all those areas that nobody in the right mind wants to touch right now. But then you get that demoralizing test of the low, and it's there that our game plan is to get more offensive. Because I frankly don't like
it. Tony, not yet. On the macro market, the advice to the viewers: do not get aggressive yet. Correct?
Well, it depends. Okay, so this is. I mean, if you're a trader,
Tony, I love you, brother. We got to move on. Yes or no?
Okay. No, I'd wait until the test from an investment standpoint.
All right, Tony Dwyer, Canaccord Genuity. Tony, I appreciate that. We are commercial free, but we still got a lot stacked in here. Guy Adami, when I look at the few things that were higher today, auto parts were higher. No idea. Dollar Tree. You know what? You know what tends to move up when things slow down in the economy or recessionary? Those types of companies. In your mind, when the data comes out, and sort of I asked Tim this in a backward way as well, are we in, right now, a recession? Will we go into recession?
Well, now I know we have a lot of time. What causes a recession? So in my world, my crazy world, a stock market sell-off causes a recession. Why? Because people get spooked. They stop spending money. We're down 19%. With this coronavirus, people are absolutely spooked. So are we there yet? No. We're on the cusp of one? Absolutely. But, I don't think a recession causes the stock market sell-off. I'm probably the wrong person to ask. But I'll say this quickly again. I'm with Tim on the coronavirus thing. Go back and look in September when this whole Fed overnight repo thing started. We talked about it on this show. Nobody ever heard the term coronavirus back then. Yields were falling precipitously back then, not like they are now. Gold was going higher back then. So all the warning signs were there. We tried to point some out. It fell in large part on deaf ears because the market went up every single day. Quickly, to me, the absolute breaking point for me personally was over that weekend when Apple said, you know what, things in China are bad. We're not going to meet our numbers. The stock was at an all-time high on Friday, traded down $6 the next day. Nothing. The following day was making an all-time high. You think that made any sense whatsoever? So as crazy as you think this might be, I would say that was equally nuts.
Well, if you think about something like a Walmart, which was up, eked out a heroic gain today, and certainly has been trading, very much close to all-time highs. And yeah, I get the panic buying, the stocking, the pulling forward. But my view on Walmart is this was an expensive stock 3 weeks ago. It's only a much more expensive stock relative to the market now. We haven't even gotten into a place. Friday, we all universally shrugged off a non-farm payroll that had 275,000 jobs added and a 3.5 unemployment rate because everybody said that may be the last number you're going to see like it. Ultimately, Walmart to me is one of the great conduits of some of that job market being so healthy, and one that would certainly be the first to suffer from it. I think you have to be very careful about chasing these stocks that have been defensive because of the environment related to coronavirus that has made their business model in the short run seem very interesting, when in fact they're very reliant on the consumer, and the multiple on the stock is well past its 5-year average. In fact, it's about 25% expensive to its 5-year average.
I just want to talk about the auto parts space for a minute, which I thought was really interesting. I don't know exactly why. I don't know if it's because people think people aren't going to buy new cars, they're going to hang on to their cars longer, or it could be gas prices are going to plummet. People will drive more. Maybe if they're not flying, they'll drive. Not really sure. But also maybe their supply chain is better than some other industries. It is interesting to me, though, that space, which is very consumer driven, did seem to have a pretty decent day.
I don't know how the rest of you are gauging this, but when I go on the CDC website, and I look last week or a week and a half ago, 1,600 people died from the flu, 80,000 died from the flu a couple of years back. Now, I'm not belittling any of the deaths, but I do think that this is an overreaction because we have no idea where this is going to go. I do agree with Guy. The market wanted to sell off. They wanted to sell off on impeachment. They wanted to sell off on tariffs. They wanted to sell off on everything.
Well, I think I'm saying the same thing. I mean, I said I don't think the market was really pulling back on Corona today. And ultimately, the question is really, I asked this question, I posed this on Friday, where I said, is the move proportionate to a change in fundamentals? And the question then, the other question you ask is, well, where were fundamentals? And were fundamentals at 3389 on the S&P, were they in the right spot? I think we can. Well, I would argue, and I think there was a lot of folks looking at price to sales, EV/EBITDA, price to earnings, and able to draw comparisons to times when the market's been very bubblish. It's not all stocks, but again, I think part of this is where we came from. That's why the velocity of this move is so extraordinary.
Can I just add one more thing?
Yeah, sure.
I think coronavirus actually had a fair amount to do with today for somewhat of a different reason. New York is starting to feel the effects of maybe not coronavirus, but of the reaction to what do we do.
This is
New York
is
the psychological center of the financial markets in the U.S., right? And I cannot help but think that people involved with the financial services industry now feel this is coming to their doorstep, and it feels so much more dangerous than a
hometown overreaction.
I don't know if it's an maybe. It's
because
a hometown
every trader
reaction.
I know is either now working from home or they're split into teams.
Call it a
you
reaction.
go into work today, you go into work tomorrow. You guys never see
every
each other.
trading desk that
Everybody's doing that. Our audience probably doesn't
is
realize
splitting the trading desk just to keep 50% of the people healthy. But when I look at where you're spending the money, yes, the cruise lines, yes, the hotels, yes, the airlines, those are going to be impacted. But there's got to be an overflow that goes into other sectors that somewhat makes up for it because people are not stopping spending completely.
We'll get to that in a second because basically some government agencies are saying maybe you should reconsider taking a cruise. All right. So that major drop in oil fueling the massive sell-off today, or at least a big contributor. Crude down 25%, biggest one-day drop since 1991. The energy stocks, they got, obliterated. I don't know if that's too strong of a word. Probably not. You had Occidental Petroleum losing 52% of its value today. Apache, Diamondback, Marathon Oil losing 40+%. You name it. Let's bring in Mike Bradley of Tudor, Pickering and Holt. He's been on the front lines of this. We've been talking for about 2 years on this debt issue out there, Mike. So tough day to have you on, but we certainly appreciate it. And did the market deserve, a terrible word, I guess, should the market have sold off the way that it did? Did Occidental deserve to lose 52% of its value today?
Yeah, I don't know. Look, I think the biggest issue with today's market was not only crude oil prices, but the debt markets really came apart today. You're seeing some really high-quality E&P names where the debt was, par 2 days ago, and now it's trading at 60, 70 cents. I think that was the big driver. Illiquidity in debt markets really took some of these equities down. And anybody that has any leverage on the system and anything is questionable, it's just got destroyed today. And so that was the main driver. It's probably been, it feels very much like Q1 of 16 when we saw, high yield books blow up and debt really fall out of bed. That's what today felt like. It felt like a lot of illiquidity, and it felt like it was less about crude oil and more about just fundamentals, financials, and debt for these guys.
Do you think, we asked this on a macro market level, Mike, I'll just focus on the energy stocks. Do you feel like today was the washout? Nobody seems to agree it is for the macro market, but for the energy stocks, was today the worst it gets?
Yeah, it was pretty bad. Look, I mean, we got some of these things are so technically oversold here. But the one thing we would say is that we did not see a lot of guys stepping up to these names today. I think what people are looking at is, okay, is this going to be a 2 or 3 month issue with OPEC and with coronavirus, or is this going to turn into a 12, 18, 2-year type event? And I just don't think a lot of people right now, are falling either way at this point in time. So I think it was warranted. Probably, it's probably oversold today, but I just don't see really many buyers coming into these stocks at this point in time.
Hey, Mike, it's Tim. Again, thank you for joining us. Crazy markets. What does it take to be a hero in terms of doing the balance sheet work and assessing some of these first lien loans? And again, our viewers aren't trading in this stuff, but you are. And at some point, valuations matter and things get kind of, credit can be qualitative. It's also a numbers game. What do you need to see?
We just don't see a lot of people buying these stocks yet on valuation. It really is certainty. And you saw it today. A couple of these E&Ps came out. They cut spending pretty aggressively, and you're going to see them. A couple of these E&Ps are just not going to grow next year. In fact, they're probably going to decline. I think that's what people are wanting to see. They're delivering it, and those stocks outperform. You're going to see a massive amount of announcements over the next probably 2 weeks. You're going to see production. You're going to see CapEx coming down probably 30 to 35, 40%. And you're going to see production next year is going to be declining in the U.S. It's going to be the first time we've seen this in probably 4 or 5 years. I think that's what market participants want to see. They want to see a healthier market. It's getting washed out. Valuation will matter at some point, but we've got to get the coronavirus uncertainty. And we've got to get the uncertainty on OPEC, what they're doing right now and how long are they going to take this.
Well, we know what they're doing, which is they're fighting. And they've all retreated. It's every country for itself and every company in America for itself. Oh, if we could, guys, can we bring up a 10-year chart of the XOP, the Oil and Gas Services ETF? Because I want to focus on this, Mike. I mean, the XOP, it's a widely traded ETF. It's down 89% from its highs of just a couple of years ago. 89%. In other words, the market is predicting that many of these companies, and I don't think this is hyperbole or some sort of, fear-mongering statement, are going to go out of business. Is it that bad?
Yeah, you're probably going to see 15 or 20% of the companies will probably go out of business. But, I think what's going on right now is that, it is uncertainty and people are scared. What are we hearing from clients right now? Everybody wants to see these the companies on a $35 strip, into infinity. You don't usually see that at tops. You see that at bottoms. And so, when you say, you start down in $35 oil, flat for 2 or 3 years, the valuations don't look good. We don't think oil is going to be at $35 a year from now. We think it's going to be higher. And so, yeah, we probably are in the 7th or 8th inning of this. It doesn't mean it can't get worse, but, we're seeing some good values. We're telling people to stay in the high-quality names. That hasn't really worked up to this point in time because everything's getting thrown at it indiscriminately. But, yeah, I think the industry is going to be healthier here in the next 12 to 18 months, and I do think that's going to be enough to bring generalists back to the group. Generalists did not want to get in this group simply because companies were just spending wildly. They weren't generating returns. They're going to be generating better returns, and when oil goes back to 45 or 50, the returns on capital are going to be pretty significant.
One quick final question, Mike, before we let you go. I know we got to get to Bob Pisani in just a second. Here's my question. Hedging. A lot of people coming at me today saying, you're not counting the hedges, the market overreacted. The hedge books, I get it for this year. A lot of them, WPX and others, they've done well. What about next year? The data I'm seeing shows that hardly anybody is hedged at any limit for next year. We lost Mike Bradley, or he didn't like the question. Michael Bradley, if you can hear me, a little laugh there, much needed on a Monday night. All right, so we'll get more on oil and OPEC in just a second, but we are coming up here, well, it's 5:30 exactly right now, split down the middle. If you're just joining us out there, listen, a lot of people are stuck at home or they're working hard all day. They're not just sitting there watching the markets all day like we are. So let's go now to Bob Pisani to talk about the day that was. And Bob, you've been down at the NYSE now for how long? You're not trying to date yourself, but how long have you been down there for us?
23 years I've been the floor reporter at the New York Stock Exchange, and you don't see days like this very often, Brian, thank heavens. It was a double whammy. That's the problem. The inability to figure out the economic impact of coronavirus on corporate earnings, well, that's bad enough. We had to deal with that. Then you throw in a sudden price war between the Russians and the Saudis on oil, and you have the makings of a very ugly day and a particularly ugly open. That's what I concentrate on here. Within 3 minutes of the market open at 9:33 a.m. Eastern Time, the stocks were halted system-wide due to circuit breakers that kicked in when the S&P dropped 7%. That triggered a 15-minute trading halt. This was the first time that the modern circuit breakers had kicked in, and it did its job, basically. The job was to pause the market and create liquidity. Stocks then rose when the market reopened 15 minutes later, but the damage was done. We ended right near the lows for the day. Energy stocks in particular were clobbered. Exxon down 12%. That's the lowest close since 2004 for Exxon. If there is a poster child for the woes for energy, Halliburton, 3 trading halts, one for the S&P 500 at 9:33, and then 2 individual trading halts at 10 a.m. and 10:22. You see Halliburton closing down about 37%. Other economically sensitive groups also got hit hard, particularly banks and industrials. J.P. Morgan down 13% or so. That was the worst decline since the financial crisis in March 2009 on a single day. Industrials like Boeing, Caterpillar, United Technologies, all down 9 to 13%. This wasn't, though, a complete bloodbath. We finally saw some differentiation in the marketplace. Some stuff held up a little bit better than others. Generally, they were consumer names, and not just Walmart. Walmart was the only stock that was up for most of the day, not at the close, but most of the day. Defensive names, Pfizer, United Health, down, but outperformed the broader market. Same with Procter & Gamble, same with Johnson & Johnson, same with Pfizer, all down 3 to 4%. Horrible days, but far outperformed the broader market, down 7.6%. Only good news here today is the circuit breaker did serve to sort of halt the horrible sentiment at the open. And the reopening, things were a lot calmer. And the VIX, in fact, did drop after we reopened, although still very, very elevated. Brian, back to you.
Oh, Bob, we are glad that you are down there. 23 years of historical knowledge and wisdom in dealing with this. Never flustered. Bob Pisani. Tim, you lived in Russia. I want to ask you a question about OPEC, because if oil helped drive us down, okay, here's the thinking. And I wrote about it this weekend, by the way. I think it's still up on CBC.com. The Russians ostensibly wanted to punch U.S. shale in the face because Trump put sanctions on Rosneft. Rosneft is the big Russian oil company. It's run by Igor Sechin, who is Putin's former employee and ostensibly best friend.
Well, Trump didn't put sanctions on Russia. I mean, those were legacy sanctions. But
on Nord Stream, and put it this way: if the two can talk, you think there's any chance that there's anything we can do, back channel, to get Russia back to the table with the Saudis and get the OPEC deal done, which might stabilize oil and thus the market?
Yes, but ultimately you have to ask what is Russia's negotiating tactic and what are they trying to achieve? And you know, my view, having spent a lot of time in Russia, is first of all, I can just tell you that the oil and gas industry gets more profitable as the ruble devalues and we get in crisis moments, because actually the oil prices are at higher levels of taxation, at higher levels of oil, but more importantly, they have local ruble-based costs, which actually get cheaper when the ruble devalues, and they're dollar exporters. So they're much more profitable in this kind of an environment. So Russia doesn't mind this environment. They also have a budget which fiscally breaks even at $43 a barrel. Saudi's at 85 a barrel. So who's got more pain on the budget side? And Saudi's been very clear about their move away from oil and their 2030. And the chaos in Saudi Arabia right now that we're also hearing anecdotally, I think is something that Putin is seizing. This helps Putin's negotiating in the Middle East. Putin's got a game plan. He's got a game plan of helping Venezuela, other wounded OPEC players. This is part of the whole tactic. And I don't think Putin needs to rush to the table here, frankly. That's just a view. And therefore, it's a view I have that this volatility doesn't serve anybody. But U.S. shale is free cash flow positive above 50, and Putin knows that.
Yeah, what's interesting is I thought we wanted lower oil prices. I thought we wanted lower rates. I thought we wanted a lower dollar. Now you're getting everything you want, and look what's happening to the market. Sort of be careful what you wish for thing. So I'm sort of with Tim on this thing. I don't see any compelling reason for anybody to go to the table. It is It's economic warfare, and it pains me to say it. Right now, we appear to be losing.
42 used to be long-term support. This is what I've been saying for a couple of weeks / months here. I never expected it to break down this precipitously. But once you break down and you get below $30, then you're in a world of hurt. You look at that 26.55 level. So I do still think that people, for the most part, want lower oil. They don't want it for this reason. But ultimately, a bunch of companies are going to go out of business. It's going to be survival of the fittest if anyone's left. And then we'll recoup, regrow. But until that, I think you're going to see lower for longer.
Yeah, and you heard Mike Bradley say it, 15 to 20% of the equities could be gone away. And by the way, many of them are down 99%. I mean, literally, that's a number. All right, the market crashing through several key technical levels in today's brutal sell-off. Is there any support anywhere out there? Cornerstone Macro's Carter Worth over at the Plasma. Any support anywhere, Carter?
Rubbing his hands together,
You could just pick your levels. But let's first talk about the concept of a bear market. Now, headlines are always focused on the 20%, and really no one knows where that came from. But let's use that. If the Russell 3000 is the broadest investment aggregate we have, covering essentially the entire investable universe, which is obviously the S&P 500 plus the next 2,500 stocks, these are the numbers. 2,467, 83% are already down 20. So is that a bear? Or how about down 25? 72% of the constituents are down 25. Or let's go a little further. How about 30? 60% of the constituents in the largest aggregate we have are already down 30. It's a bear market. You can call it what you want. We know what it is, and it's presumptively not over. Where can it go? It's anybody's guess, but let's look at some lines. So actually, same deck here for the S&P, and this is the point, right? 20%, 66%. More than half are down 25. So we have a few big marquee names that are holding up. As if and as they succumb, we know what happens. So in terms of levels, here's the long-term chart. This is the financial crisis low, the 6th of March, 2009. This is the U.S. debt downgrade in 2011. Right here, the 2016 industrial earnings recession. Right here, the plunge low of December. And so were we simply to come down to trend, which is 2,500, that's another 7%. Perfectly reasonable. But the real question is, could we get to the December lows? Could we give back this entire ricochet of the past year? We know the S&P is not it, but the transports have already taken out the low. The bank index already taken out the low. The Russell 2000 and the energy. So let's look at each of those, and then let's quit. The S&P, were it to get down to its ricochet low of Christmas of 2018, would be another 15%. The Russell 2000, on the other hand, would be a mere 4. Just 4. That could happen tomorrow at 9:32. Could happen next week. But the point is that's a foregone conclusion. And then here's the real issue. Look at some of these other aggregates. What we have is the transports. The transports have already taken out their Christmas low. And the key here is they never could make a high, never confirming what the S&P was doing. And finally, take a look at the bank index. Never confirming the S&P's new high and has taken out the low. None of this is good. And sure, you can get bounces along the way, but bear market, got a lot of problems, and let the dust settle before getting really excited about buying.
Yeah, we'll see if the dust does settle. Come on over. So Karen, if you look at Carter's chart there, I think I did the math a little bit. We're looking at about maybe we could have another 7 to 9% down on the S&P 500 to hit that 2,500 super long. Nice elbow bump. If you're on the radio, they just bump elbows.
Practice.
Super long-term support.
The trend line, right? Think about it. Those are pretty important reference points. The 09 low, the U.S. debt down in 2011, the 2016 low, and the 2018 low. Were we just to simply touch that, that's 7%. But from there, it's anybody's guess. The real issue is the market, which made a new high, was never confirmed by most global aggregates, by the banks, the transports, and it calls into question whether we do really test the December low.
So you had talked about the Russell as being only 4% off of that.
That unbelievable plunge low, at which point it was itself was down 30%.
So does that make it more attractive to you relative to the other ones? Or not on a relative basis? I won't hold you to an absolute.
Yes, that's one way to look at it. One could say since it's so much worse, therefore it has more bounce potential. But I think it's because it's got so many things that are playing. First of all, its weighting in financials, as you know, is almost double that of the S&P, and small regional banks with rates and so forth are in real trouble. My hunch is that it's just it's a preview of coming attractions for the bigger indices.
And coming attractions are not things we tend to like to sit through.
I like the coming attraction. Sounds like a coming attraction of a bad movie. I mean, the bottom line is you see more downside likely ahead.
I think that's the message that I would convey, but I think it's also it's also this. Let's say it's not about the downside. Switch the subject. Let's say we never go lower. There's always downside in investing. We know that. This is not, tiddlywinks. It's about the upside. The upside is capped. If you look at the statistics on how long it takes to recover from a 20% decline, the median, it takes about 2 years. That's right. That's a problem.
And this may be where you're getting to, but let's cut right also to literally the shape of these charts. Investors are become so inured to expect a V-shape recovery. And we talk about it in the context of economies, and is it going to be a V-shaped recovery from the coronavirus? Who knows? But the charts themselves, that's a big ask. And
especially since we had the V off of the December.
Well, that's the reason they expect
second V, right? And usually you don't. Meaning it's tricky to pull off a V. They're rare. U's are common. You heal, you cure. Ricochets are impetuous, impulsive, and they're rare.
All right, Carter, good stuff there on those charts. I mean, really long term, that Russell chart was incredibly dramatic. Carter, thank you very much. Need you at a time like this. All right, meantime, President Trump meeting with his economic team about the coronavirus and the economy and ostensibly the stock market. All within the past hour. Let's get out to Eamon Javers, who is at the White House with more. Eamon.
Brian, we were told that meeting began shortly after 4 p.m. this afternoon. Not sure whether it's broken up or not, but I can tell you that the vice president's press conference on coronavirus, which was scheduled to start at 5:30, has now been pushed back to the top of 6 p.m., and they have replaced the vice presidential seal at the podium with the presidential seal at the podium. So it seems likely that we will hear from President Trump at the top of the hour now, and we may get a readout on what he decided, if anything, with his economic team. I was told they were going to go into that meeting and present the president with a list of options in terms of economic stimulus and response to the coronavirus economic damage that we've seen so far. So as you take a look at that podium now in the briefing room, we do expect to see the president there shortly here, and we'll also have a chance to ask him about his meetings upcoming with those Wall Street CEOs. That coming up on Wednesday. And then the vice president will be meeting here tomorrow with health insurance executives as well, all as part of the administration's coronavirus response. So we should have a little bit more news for you here in about 20 minutes' time, Brian.
I don't want to put you on the spot, Eamon, with rumors and speculation, but I mean, I know you're there. You got your ear to the ground. You're literally seeing some of these folks walk around. Do you think there's any real shot of some kind of massive stimulus pack? I mean, literally, sending a $1,000 check to small business owners or taxpayers?
They're skeptical of that idea here, right? I mean, on Friday, we heard Larry Kudlow dismiss that as helicopter money, pointing out that it hasn't worked in the past, when George W. Bush tried something similar. They don't like that idea here. On the other hand, that was about 3,000 points on the Dow ago that Larry Kudlow said that. So we'll see where the thinking is now. My sense is that what you've got here is a largely free market-oriented economic team and a largely protectionist president of the United States. And so those two things are not always on the same page. And the president is definitely one for big gestures. He's one to sort of go for the moonshot solutions a lot of the time. So you could see a scenario where the president looks at that menu and says, I'm going to go for the biggest possible option here. But we'll just have to wait and see. I don't know what they presented him with in that meeting, and that meeting may have just broken up or be about to break up right now.
Hey, Eamon, it's Tim. Can you talk about the health czar talking about the economy today? Can you explain what that was?
It was unusual. So that was the HHS Secretary, Alex Azar, who came out on the driveway behind me this morning. He was doing some television interviews on another network. Then afterward, he came over to where the press was gathered to try to get some questions to him. He came over to the microphones and gave a prepared statement about the stock market and said that the president has delivered the best economy and that the fundamentals of the economy are strong. He reacted to the stock market. He said it's been very active today, but the economy ultimately is strong. That's not a message you typically hear from the Secretary of Health and Human Services at the White House. Usually that's a Treasury Secretary message, a National Economic Council Director message. Presidents, typically don't talk about the stock market really much at all. But in this case, Azar clearly felt like he wanted to deliver that message. He came out, he delivered that message to the microphones, turned and walked away and didn't take a single question. So it was clearly a planned thing, but it's just an unusual thing for them to do that way.
Yep. Thank you.
All right, Eamon Javers, Eamon at the White House as we are waiting that press briefing as well. Guy Adami, if we got some kind of fiscal package, literally stimulus of some kind, small business, direct payments,
right?
Will that help the stock market?
Of course it will. I mean, It's, and I don't know the answer to this. Steve does, and I actually don't know the answer. Are there circuit breakers on the way up?
No.
Yeah. Which is fascinating to me.
There used to be, I think, but now there's 11 different stock markets or something. So you have stuff on the way down, but you don't really have that methodical.
Yeah, I bring it up to point out the absurdity of the whole thing. But you know, absolutely. Now, quickly, if you can remember back to, I think it was February 8th, 2016, market traded down, the S&P traded down to 1810. If you recall, in August of the previous year, you had the China yuan deval, the market was on thin ice, and it cratered that day. In the aftermarket that day, you saw Jamie Dimon buy a significant portion of JP Morgan stock for himself when the stock, I think, was trading 53. I think you had a Deutsche Bank bond offering as well, and you had some sort of OPEC news, and you had three things. The market never looked back. If we get a hint of that, to your point.
Casinos were buying their stocks, too.
Absolutely. Yeah. Absolutely. If you get a hint of that, then yes is the answer. You know, that's what the market wants. I'm not necessarily sure it's going to get it. But we'll see.
But I think, Brian, it's a case where all we're talking about tonight is uncertainty. And yes, fiscal path forward can give you some confidence. I think it probably gives you more confidence that politically we're able to get things done at a difficult time, which are in the best interest of the country. But I just think right now this is the issue with stepping in on multiple fronts. It doesn't mean that assets have to get a whole lot cheaper, but the grinding around in the sense that equities are going to V-shape and get away from you, even on a fiscal package, when you still don't know the credit story of a number of companies, and again, people are starting to talk about big industrial companies, but certainly go through those transports. And I don't want to name companies at this point. I do think that there are
fiscal would help more than the monetary would help. Let's not forget the stimulus package under Obama was passed, I think, February 11th or something, 2009. The market bottomed like a week later. Now, very different scenario than I get it. But if you're looking for any equated to the circuit breakers any today. kind of stimulus, whatever it is. All right, well, today's big sell-off tried to send some investors into gold, but not as much as you might have thought. Yeah, gold ticked higher a little bit, but certainly not the move many may have thought. Let's bring in Bill Baruch. Bill, thanks for joining us here on set.
Thanks.
Were you surprised? Was it just that everybody was selling so much, nobody had any money left over to buy gold? Seriously?
Yeah, that's a good point, because really, even if you look back at 2008, gold sold off in 2008. It wasn't until the aftermath, when it rallied in 2011, went to $1,900. Went down to about $800 in 2008. So I've traded gold for more than 15 years, cut my teeth on it. I've always lived by the narrative, you don't want to be buying gold when everybody's screaming for it. You want to be capitalizing on gold that you already own at that time. So I think gold's struggling around 1,700 right now. And today, you would imagine it should have gotten out above there. It couldn't. The high in gold, I think, came on the open in the S&P. The S&P sold off another 100 points. And so I think you don't want to chase gold up here. There's going to be a buying opportunity, and it's already up 11% this year. So you look from that standpoint, it's not the time to be buying. It's wait for a pullback here.
What about silver?
Yeah.
That's another great point. Look at all the metals. The metals got creamed. I think platinum was down $30, palladium was down $30, copper was down, silver can't get going. And I think that's another thing you want to keep a pulse on, because when silver finally turns, that could be the really great breakout that could send gold to new all-time highs if silver ever catches that bid. And the other thing to keep an eye on if you're trading gold is watch treasuries, the yields. And one thing that kind of concerns me a little bit in the near term is we've seen when quantitative easing QE1, QE2, QE3, yields bottomed within a month of that every time. So if yields bottom and come up a little bit, that's not supportive for gold. But again, that aftermath is what will help gold break out.
So I got to tell you, been a gold. I never got gold. I never got it. So I thought a lot of the fundamental story was an inflation hedge, right? We couldn't be heading more toward a non-deflationary scenario. How is it that doesn't sort of undermine the gold bull?
Well, I think you're right. I mean, it's a narrative, I think, that's been flipped upside down. I mean, we're going into a deflationary environment right now. And really, I think gold's going to be driving off the dollar. If the dollar's weak, gold's going to be priced off dollars. And again, dollar was down a whole %, the dollar index today, and more than that maybe. But gold couldn't break out. So I think you got to kind of forget that narrative for a little bit. But there's times if we get an uptick in inflation, you've seen supportive for gold that day or that week.
Bill, when you look at Bitcoin, has it helped or hurt? It feels like it's helped the movement or the movement of money back into gold. And if you want to make a headline here, people have talked about $5,000 gold. What's your upside target long term? Do you have any multiple thousand target range? Because you hear that it could be the 5,000 range.
You know, I don't put those really absurd or kind of outlandish targets out there. I think it is realistic to see gold above 2,000 and 2,200, 2,500 in the aftermath of this. Speaking of Bitcoin, though, I sort of took that off my radar, my everyday radar recently, or turn of last year. I think you got to keep a pulse on it. But look, I think was Bitcoin down 10% today, and the fact that it couldn't capitalize on that, I mean, it's not a safe haven. But again, where gold is, you would think it'd be a safe haven capitalizing on a day like this. It didn't. It's it's the aftermath.
We'll get you back on, talk about more of the industrial metals as well. Wonder what their signal is. Well, listen, all these companies, most valuable commodity in the world, we know what it is right now.
I have no idea.
Thank you very much. It's not gold. All right, let's talk about this. You're a gold guy.
I understand what he's saying. I mean, you go back to, I was actually working in 1987. I remember the day, market was cratering, much percentage-wise, much worse than we're seeing over the last couple of weeks, and gold caught a bid, then all of a sudden it cratered. We saw it again, I think, 08, 09. There have been periods in history where you say, gold should go higher, and it doesn't. It actually makes sense for a myriad of reasons, not least of which source of funds or people getting out of things they have profits in. I happen to think gold, the story is not going away. And again, don't at me, but I think the next big problem is not going to be the rates continue to go down. It's when this genie is out of the bottle and you get this inflationary period where I know nobody thinks it's coming. First of all, there is inflation. The Fed just chooses not to measure it. Another conversation. Second of all, the turn in this is going to be so violent that the Fed's going to have no bullets, and that's when gold's going to be a story. There will be a time this year, in my opinion, where you walk in, it's up $200, people are looking around, and the next day it's up another. Yeah, you can timestamp that sucker for me.
Guy Adami with the bold gold prediction. All right. Today's sell-off also drawing huge moves in the options market. In fact, let's get to Mike Coe in San Francisco. Mike, they told me you're going to talk about tonight, and I said there's no way that that's true based on the stats, but apparently it is. Tell us about the put buying.
Yeah, so we were looking at HYG, which is the high-yield bond ETF. Now, it is conventional to see more puts than calls trade in this thing, but nothing like what we saw this morning. The put volume was outpacing calls by 50-1. And actually, of all of the ETFs, this was the second most active in terms of its put buying. And that's pretty extraordinary because the only one that was higher was SPY, which is obviously a much more heavily traded instrument overall. Implied volatility, which was right now we're looking at the price of 90-day at-the-money volatility in HYG, is basically at 10-year highs right now. And the activity that we were seeing that I was looking at was the March 81 puts. Nearly 40,000 of those were traded for about $2. Those are making bearish bets in HYG that it could essentially retest levels that we saw in 2016. And actually, that's an interesting point because the 2016 lows, we are seeing stress, but we aren't seeing a crisis necessarily in these prices. A lot of the issuers, as you know, Brian, like in the energy space, for example, the equities are trading like grim death. This could potentially go a lot lower if we take a look at where yields are, which are still under 6%. So I think there is room potentially to the downside. That seems to be what some people are betting on.
Mike Coe, truly some unbelievable numbers there. Mike, thank you very much. All right, Tim Seymour, I honestly, I'm not the pro you are. I just don't know if I've ever heard of or seen those types of numbers.
Brian,
in
you
that
are
kind
a
of
hell of a pro. Let's be clear about that. No, when we look at the HYG and you look, once again, maybe the term of the night, the word of the night, velocity, this moved down quickly to those Dec 24 2018 levels where high yield was hemorrhaging. And again, what happens is there's no bid. There's absolutely no one to step in. And what we heard from Mike on the energy side, what I was hearing from high yield and distressed traders that I speak to reasonably regularly, certainly during days like this, this is where we are. And there's no sense that assets have really found a price. Again, if you're looking at higher first lien loans in the high yield space, these things have gapped wider. So you can imagine as you get further down the curve. So what Mike Coe is telling us is that options traders or people that are playing in the high yield space view that this move is set to break those December 2018 lows. And this is a credit move that I think is going to be equity negative.
Okay.
Let me just add one thing real quick. The LQD, which is investment grade, that index also down. Normally, with rates lower, it goes higher, down a lot today.
Good point there. All right, so we are coming up at the top of the hour, and of course, several key markets in Asia. They are about ready to open for the day. Let's get your setup now with CNBC's Will Caloris, who is live for us in Sydney. Will.
are expecting another significant sell down when it does come to Asian markets. We saw the Nikkei coming off by around 5% yesterday. It's looking like an implied open of around 800 points down, which would suggest around a 4.5% drop. And it is interesting because the only strength we're seeing there is, of course, in the US dollar-yen cross, but also Australian markets are expecting another considerable sell down as well. Right now, the SPI futures are showing around about a 4.8% drop-off when it does come to the Australian markets. But I suppose the one saving grace is the fact that we've already taken our licks when it does come to the energy sector. They did see their worst day ever yesterday when it came to all those plays, and at the same time, we really hit that 30% drop-off already, so perhaps there will be a little bit of easement when it does come to those energy plays as well. And also, just quickly, I do want to touch on the fact that the Australian Prime Minister is speaking right now, and that fiscal stimulus is expected to come through shortly. So the hope is that we might perhaps see a little bit of a turnaround in the Australian markets moving forward, guys.
All right, Will Kalouris in Sydney waiting on that open. Maybe circuit breakers there. Will, thank you very much. We got some breaking news right now from Wilfred Frost joining us by phone about this meeting with Wall Street executives in the White House tomorrow. Wilfred, what can you tell us?
Hey, Brian. Yes, indeed. So I can confirm, not tomorrow, but on Wednesday, the White House meeting with President Trump will go ahead with the bank CEOs Wednesday, 3 p.m. Eastern time. The nation's biggest 7 banks, from J.P. Morgan down to U.S. Bancorp and all in between, have been invited, maybe more as well, but certainly those 7 have been invited. And I know at least 2 of those will send their CEO, I would imagine. All would send their most senior executive and CEO, other than, of course, J.P. Morgan with Jamie Dimon currently out of action. Some industry bodies have been invited as well, including the ABA, the American Bankers Association. So this is shaping up to be quite a large and significant meeting. Not often you get all of those individuals in the room at the same time, of course, due to take place in the White House with the president Wednesday, 3 p.m. Eastern time. Brian?
All right, Wilfred, thank you very much. Wednesday, 3 p.m. Eastern. I moved it up a day, Guy, but maybe they need to have it tomorrow instead of Wednesday. Will these executives be able to do anything about what happened in the stock market?
Not necessarily, but I think it'll definitely be a calming force. Look, again, we're not here to hype up when it's higher, to scare everybody when things are going lower. It is what it is. I mean, this is what we're living through. We got to deal with it. People getting together, it's not a bad thing. If something comes out of that, that's fantastic. I do believe, and Karen and I spoke about this earlier, there's going to be a day, whether it's this week or next, where you see the Dow Jones Industrial Average up anywhere from 2,500 to 3,000 points. It's not out of the realm of possibility, given what we've seen. And quickly, if you want just to look at something, Carter talked about it before, that 128 level or so in the IWM, the Russell, is a huge level. Now, if we can hold there, the Russell never verified the move up in the S&P, but if it can hold 128, maybe it'll lead us back to the way up in the S&P 500. So for me, the most important thing today, at least, is that 128 level in the IWM.
All right, 128 on the IWM, guys. All right, so we got about 90 seconds left. We've been commercial free for the last hour, so let's try to figure something out for tomorrow. Not really a final trades, Tim, but just kind of getting texts like is the market going up tomorrow?
Well, and certainly like kind of a do's and don'ts. And certainly, look, my view is that there's been extreme selling and that there's many things that are oversold. And as much as I've harped on fear of credit, here's what I think you should do. I think you need to have a plan. So don't not have a plan. So forget the double negative. Have a plan on stocks that you want to own and at what level you want to own them, irrespective of the environment. Requires doing a little bit of work, requires having I think a bottom-up view on things, but also I think that's really, you have to be without emotion.
See, I think you have to look at what today's lows were, whether it's a single stock or whether it's the overall market index, and I think that's where you start to look for a bounce. Wait for the panic to subside a little bit on coronavirus. The more we learn, I think the less panicky we'll be.
Yeah, well, first of all, you don't have to do anything, but what I'm looking to do is add to positions I love, like Google, as it gets cheaper every day. I'm not looking to buy protection here. I think you've missed the boat if you're looking to buy protection now. It's too late.
It's always painful, but it's absolutely necessary. And you know what? This one doesn't feel good, but I think it's the best possible thing. We'll get through this as well, Brian.
All right, good words there, guys. Great show tonight. Commercial free for an hour. Thanks very much. We'll see you tomorrow. Mad with Jim starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm
I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to educate and teach, do a little entertaining, but put it in context. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Let's not mince words. This is one of the worst days in the history of the stock market. A day where the circuit breakers got activated, down 7%. A day where oil had its worst decline since 1991, down 24%. A day where the 10-year Treasury went below 0.5%, a record low, which tells you the bond market is terrified. It's also a day where you probably lost a lot of money. It's probably what happened to you. That's because, of course, the Dow plummeted 2,014 points, its worst point drop ever. S&P plunged 7.6%. NASDAQ nosedived 7.29%. It's funny. I remember when the Dow Jones average was at 2014. Now it lost that much. Whoosh. So, okay, it happened. Don't like it? It happened. What the heck got us here? Where do we go next? First, today's sellers fear that we're going into a coronavirus-induced recession, and they're trying to get out of other people who want to sell, just trying to get ahead of them. Now, that may sound fanciful, given that we've had less than 600 cases in this country and only 22 deaths. In the end, it does seem to some like more of a super bad flu than the bubonic plague, yet all sorts of people saying all different things. As the president tweeted earlier today, 37,000 Americans died from the flu last year, yet, quote, nothing is shut down, life and the economy go on, end quote. But the markets were not reassured by that or anything else they heard today. Not the bond market, where Treasuries spiked with their yields sinking to frightening record lows. Not the stock market with its breathtaking breakdown. Not the oil market. That market down 24%. And that a lot of people fixated because that came out of nowhere. So who's right, the president or the markets? Was Trump correct when he told us that this oil price war between Saudi Arabia and Russia will be good for the consumer because it means lower gasoline prices, so we should be more bullish? Here's the thing. Cheaper oil would have been great for us a decade ago. But these days, the United States is the world's largest oil producer and an exporter. If prices stay down here, some of our producers will default in their debts. And we'll end up laying off a lot of workers in the oil and gas companies, the service companies, and the pipeline complex. Therefore, oil price may actually be more negative than positive and ripple right through the stock market right down to the banks. As for the number of people with COVID-19, sure, we've diagnosed less than 600 of them, but some of that's because we don't have enough test kits. And in some areas, they don't want to test you until you're very sick, not just running a 100-degree fever, for example, but very sick, further along. I find that ridiculous. Americans won't take the positive aggregate number seriously until we get a better handle on this pandemic. Until then, they're not going to feel confident about going out or traveling, congregating anywhere. Even as we've seen a peak in Japan and China seems to have stabilized, perhaps Singapore's peaked. It's only Italy which just froze travel and seems pretty, I'd say, scary. And Iran with who knows what. That's truly out of control at this moment. Now, when it comes to the sinking travel industry, who wants to take a vacation when you see all these people on Carnival cruise ships getting sick? 700 of them in Japan. It's like two-thirds of what's going on in Japan was one cruise ship. By the way, it's bizarre that we aren't testing every person on every ship. And where are all the ships? Is that what do we have to keep waiting until they come to dock? We got to get our act together here. At least Dr. Tony Fauci, America's top epidemiologist, had the good sense to warn people away from cruises, although obviously the bad sense if you work at a cruise ship or if you're a shareholder, which you shouldn't be. These plague ships made it crystal clear that it's way too easy to catch the coronavirus. And the infected nursing home in Seattle proves that it's way too easy to die from it. If you're elderly, if you're sick ahead of time, that seems to be the population. Doesn't minimize it, doesn't make it, well, we don't have to worry. So what needs to happen to fend off a recession? Well, there are four things I really want to see here. And by the way, we get these four, and I'm not going to just fend off recession. I'm going to tell you to buy stocks, okay? But we need these four. Mr. President, we need these four. First, we need some serious fiscal stimulus as monetary policy's gone as far as it can go. The government should be offering no-interest loans to small businesses that won't be able to handle the downturn. They didn't do anything wrong. We should subsidize companies that give their employees paid sick leave because it's very hard to quarantine yourself if you're living paycheck to paycheck. Mr. Treasury Secretary Mnuchin, please stand up. You know exactly how to do this. You would calm the markets. Second, how about a change of tack from the president? Now, he's got a hope for the best attitude, and that's the attitude my father always emphasized to me, so I'm not doubting it. I also think, though, he should be planning for the worst, like my mom would have. We'd all feel more confident if everyone on a cruise ship is tested. Maybe test everyone coming from overseas or everyone in a big gathering, or certainly everyone who has a 100-degree temperature, for heaven's sake. I don't think this shows weakness, and it doesn't undermine the idea that things might be better than most of us believe. The more data, the more testing, the better we trust the figures. credibility. Let me put it this way. The markets are craving leadership. And that's what the Dow and the 10-year are screaming in unison. Playing golf is a way to placate and keep people going about their business. I mean, it's kind of like a keep calm, carry on thing. But going after your business during a pandemic, it doesn't work. It puts people in danger. Now, we saw that during the devastating Spanish flu outbreak a century ago. We need to take a short-term hit here if we're going to contain this thing. Self-quarantine, work from home, stay away from the crowd. All this slows down the pace of the infection, gives healthcare workers a chance to breathe, which is what really matters. Third, we need the White House to push for a vaccine or a treatment or even just some better information, data that would allow our scientists to solve this thing. Why not convene a Manhattan Project with the smartest minds from all industries? I know he's bringing in people tomorrow. Make them commit to fixing this. Private industry, right? Hey, why not hand out big prizes left and right to anyone who can make some progress against the darn thing? $100 million tax-free to the scientist who comes up with a cure. We give out a lot of money in Powerball, for heaven's sake. I mean, is this better use? Fourth, you go to war with the healthcare system you have, not the healthcare system you want. We need to back our community-based health system with unlimited resources, everything from mobile Army surgical hospitals to ventilators and respirators and hazmat suits. State and local governments don't have the money to pay for these things. This is what the federal government's for. Why not do a gigantic bond offering? I don't know, do a $300 billion 30-year that everybody wants so badly. Wish list aside, let's circle back to the big question. Can we start picking through the rubble after today's devastation, or is there more bad news coming that still isn't priced in? Look, I think we're on the eve of recession unless we get some major stimulus from Congress to restore confidence. And even that might not be enough because this is a public health problem. Remember, it's a biological crisis. The last time we were on the eve of the recession was December of 2018 when Fed Chief Jay Powell raised interest rates too far too fast, then promised us still more tightening to fend off non-existent specter of inflation. And not his finest hour. Back then, the stock market took a huge header. The S&P plunged as low as 2347. Keep that number in mind. 2,347. Dow tumbled to 21,713. Those are useful benchmarks, right? And if we repeat that action, well, we could have a lot more downside. A useful benchmark, down 15% more for the S&P, down 9% more for the Dow. Now, those are extreme. Okay, but there are going to be a lot of stocks that are valuable with it. Between here and there. We bought some stocks for my Chapel Trust. You follow along at actionalertsplus.com. We bought them right near the bell. Felt pretty good about it. All right, I've been bearish about this market for weeks now. A lot of people call me a panic monger. All weekend I had to oh my God, fear monger. I had to stop looking at Twitter for a while. I mean, I'm not a panic monger. This is panic. I was trying to get you out ahead of the panic there. I do believe there will come a level where it makes sense to start buying even more aggressively. 2 weeks ago, Warren Buffett told you to buy, arguing it's a mistake to try to time this kind of market. It's the same call he made during the financial crisis. Back then, his call was way too early. Oh, boy, this time, too. But over the long haul, you did make a killing if you listened to him. And we might look back and say, hey, what was that Kramer thinking? He told us not to buy. I mean, well, you can start buying now. Trust did. Here's the problem. You are not Warren Buffett. He's one of the richest men in the world with almost unlimited capital. He can even lose all the money he put into Berkshire. That he committed Berkshire Hathaway to Occidental. He can afford to be early. The rest of us need a little time. We got to get it better. We don't want to be overrun by sellers. If you want to sell until we get closer to those 2018 lows, I'm going to give you my blessing, especially for groups that are in the center of the blast zone, like the oil. Stay tuned. I'll tell you what's in the blast zone. However, we got to be clear about one thing. This is not Armageddon. We have ridiculously low oil prices. Those mortgage rates have not come down enough. The prices for goods and services are coming down. Employment's very strong. These aren't bad things. They're good things. And they'll ultimately allow us to spring back much harder than most people think we could. But make no mistake, COVID-19 is causing a slowdown, and it'll be very hard to spring back if there's no fiscal stimulus, no confidence in the government. That confidence doesn't come from hoping for the best and acting like it's business as usual. It comes from preparing for the worst. We need to make more coronavirus tests and get aggressive about administering them. We need federal money to bolster our local health care systems and subsidize is stuff we don't have enough of, like ventilators. Maybe we need more hospital beds, maybe more hospitals. Most of all, we need the White House to recognize the serious nature of the disease, right? Bottom line, rightly or wrongly, people are terrified of this pandemic. It's very hard to be constructive about most stocks when the government's focused more on optics than on appropriate precautions. If the president wants to reassure the markets, he needs to consider a new approach. And if he takes it, call me a buyer.
Off the ledge more than once.
No, we don't. Yeah, but look, we can stay together. You know, look, I mean, go read Confessions of a Street Addict if you want to see about why I said they got to, let's just say, talking off the ledge. What's up?
As I stare Armageddon in the face, I just want to find a safe place to hide. What are your thoughts on Clorox, CLX?
All right. Clorox is interesting. Now, my Travel Trust sold some because we said we are being way too greedy. It's up way too much. I think it can continue to go higher, but how can I tell you to buy some if we just trimmed a little? I think you got to wait till it comes down. Hey, let's go to, here's an app name for what people did to the stock market today. RID in Massachusetts. RID.
Hey, Jim, how are we doing?
I am well. How about you?
Oh, well, I know the story. Hey, Jim, thanks for taking this call. A quick question is like I have a Roku stock bottom on the last ER, on the ER day at 145, and I had it like 2,400 shares. I'm holding it, and now it's like crushed. What do you recommend?
And this is, it's Roku. Roku?
Yeah, Roku,
all right.
yeah.
You know, this is a problematic stock because it's a high good company, but I do feel also that it's a very for another 15, 16 points and then scale down. But I have candidly not been the best on the company, and I've said that over and over again. And I don't want to say I'm just not the call, but there are other people who know this one better than I do. Or